Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. What's the first trading day of June, and NASDAQ futures there in the green, driven by gains that we're seeing in the chip stocks. Now, this follows big announcements from Nvidia and AMD.
And it's a big week of economic data out this morning. PMIs, we'll get a read on the U.S. manufacturing sector for the month of May, and we'll see JOLTS on Tuesday, ADP employment on Wednesday, weekly jobless claims Thursday, all culminating in that big May jobs report on Friday. Investors tracking all of this data to see how it plays into the Fed's thinking around rate cuts. So let's get right to it with the three things that you need to know this morning, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Josh Schaefer, and Ines Ferré have more.
Thank you, Brad. Competition in the chip space is heating up. Nvidia and AMD moving higher this morning on new product announcements out of a tech conference in Taiwan. Nvidia announcing its most advanced AI chip to date, nicknamed Rubin, which is expected in 2026. This comes just months after the company unveiled its Blackwell chip. We're also going to see another version of Blackwell in 2025. Meanwhile, AMD unveiled a new AI accelerator, which it plans to make available in the fourth quarter of this year, as well as new mobile and laptop accessories.
And the return of the meme craze is here again. Shares of GameStop skyrocketing on speculation Keith Gill, known as Roaring Kitty, may have a big position in GME. Roaring Kitty is the trader known for starting the 2021 meme frenzy around GameStop. He allegedly posted on Reddit Sunday night a screenshot of what people think could be his investment portfolio, showing $175 million of share ownership and call options. We could not independently verify this post.
And OPEC Plus is agreeing to extend most of its oil production cuts into 2025. However, the Oil Alliance said it will begin unwinding some additional voluntary reductions starting in October. The decision over the weekend was met with mixed reactions from Wall Street, with some analysts predicting unwinding any cuts this year would be bearish for oil prices. Others see the impact as neutral. The production curbs are intended to ensure prices stay higher amid demand and inflation concerns.
Well, good morning, everyone. Futures are mixed this morning ahead of the first trading session in June 2024. We're taking a look at some of the major averages here as we're zeroing in on the Dow as of right now. The futures flat just barely to the downside. The NASDAQ 100 futures pointing higher by about 0.5% to begin the month, and the S&P 500 futures also pointing a little bit higher as well here. An interesting dynamic that we're tracking, a lot of focus on chips and the weighting there, as well as the retraction, or at least some of the downdraft that we've seen in software that's really led to that weighting being more prominent in chips.
Yeah, you're exactly right. When you take a look at the early sector action, we are seeing technology, real estate amongst those, the outperformers there. We mentioned the chip stocks, some of the big drivers here of the market this morning. You don't have to look any further than Nvidia, up another 3+% here this morning. And again, when you take a look, even the last 5 days, you have seen this trend higher here, up just about 5.5% over the last month. You're looking at gains of 26%. And then, like we've been talking about now for quite some time, you're talking about that year-to-date gain of over 120%. Now, new chips out from Nvidia that were just announced, and also AMD, are looking at gains of just about 1.8% here in early trading. Year-to-date gains there of about 13%. So some competition intensifying among those leaders within the space. And then, Brad, we also got to take a look at the meme trade, because that's really what is catching a lot of our attention here this morning. When you take a look at some of that and some of the gains that we're seeing specifically with GameStop up on the top left of your screen there, I think just off the highs of the session here this morning, at least the future session have been up over 100%. We're now looking at extended gain of just about 72%. So again, it's reigniting some of that meme frenzy that we've seen over the last month. Well, let's talk about that, because we got the meme stock rally coming after a Reddit account linked to Keith Gill, also known as Roaring Kitty. He posted what appears to be a significant amount of shares and call options of the stock. Now, we could not independently verify this post, but Gill is widely credited for influencing GameStop's 2021 short squeeze. For more on this, Yahoo Finance's very own Josh Schaefer standing by in the newsroom with the latest on that. Josh.
Hey, Shawnee, yeah, GameStop shares rising over 70% this morning in pre-market trading. That's after a Reddit account using the username of Keith Gill, also known as Roaring Kitty, posted a screenshot showing a $175 million position in GameStop. That includes about 5 million of regular shares and 120,000 call options that are set to expire on June 21st. Now, what's most interesting about this right now that we're watching is we haven't actually heard from Gill himself yet. You remember back a couple weeks ago, his Twitter account started tweeting for the first time since 2021. GameStop shares took off on that. Last night, we have this post on Reddit from his old account. But again, we have not been able to verify whether or not this is actually Keith Gill behind these posts. If you think back to 2021, he sort of was most famous for posting videos of himself. He was always on the camera talking to other people, and we have not seen that part of this yet. So it'll be interesting to see if we eventually do hear from Keith Gill himself and what he has to say about this return of the meme trade.
Absolutely. Josh, thanks so much for teeing up the conversation here this morning to really break down what this means for the wider meme rally. We've got Steve Sosnick, who is the Interactive Brokers Chief Market Strategist, here with us. Steve, thanks so much for kicking off the week with us. I mean, I thought that we'd be talking about this massive week, the deluge of data that we're going to get on the jobs front, but no, we're focusing in on what's taking place with a potentially revived meme trade here. Wonder what you make of it.
Morning, Brad. Well, we're talking about the really important stuff, right? Sarcasm intended. We've got a very consequential week, as you and Shauna laid out at the open, but here we are talking about meme stocks once again. My basic premise here is meme stocks are just, they're a sign of the froth that's going on in the market. There's activity in penny stocks, there's activity in meme stocks. And, Josh just raised a very interesting point. Do we even know that at this point that Roaring Kitty's account is actually controlled by Keith Gill, or can we verify those positions that were placed there? But obviously it doesn't take much to get the faithful excited in this stock, and they are excited once again.
Steve, does this just reaffirm what we have been talking about time and time again, that this story is here to stay? And when we talk about the retail trader and some of the excitement that we've seen and clearly playing out through some of these meme trades, it doesn't seem to be going away anytime soon.
No, it does not, Shauna. It's going to be here as long as we have a market that is exuberant enough, happy enough, whatever the right adjective is, to sustain this. And as of now, we can. Think about it. The meme stock phenomenon sort of died out in most of 2022 and a good portion of 2023 because we didn't have the euphoria across the board that we have now. Individual investors are back. In general, that's a very good thing, although I'd rather they focused on more, shall we say, value-oriented types of names rather than just pure speculation, as it is in this case.
Yeah, Steve, talk to me a little bit more about that. And when you take a look at the names that we even have up on the screen right now, clearly we're all seeing this move higher. How does that then, or does it then, get mirrored into some of that broader market action?
I think they're related. I think that the meme stocks are sort of the tail, the flea on the tail of the dog, although they're a very interesting one. But it's not really what's driving the market. What's driving the market is you have individual investors who, in terms of investing in good stocks, have made lots of money in things like Nvidia and AMD and stuff that you talked about at the top of the show. Those names are continuing to work for them. So at some level, they're playing with house money, and it does embolden people. Again, I'm not upset if people are making money in stocks that are making money. This is a bit speculative, and in this case here, a bit. I'm trying to think of the right word. Manipulative is the wrong word, but at some point. Is whoever's controlling this account doing this in your best interests or in their best interests? And really, you should think that one through, because to me, it's pretty obvious whose interest it's in.
I mean, yeah, and a position of this size, especially, Steve, considering in the past what the actual thesis or the setup was going into it. You had a stock in GameStop and then AMC as well that were shorted and more than 100% shorted, essentially. So it was a squeeze of epic proportions that they were really trying to, and successfully enacted. What's the thesis this time around, to whatever extent we can gather?
Honestly, I think it's, try to try to suck in the people who are following here in this case. Now, if indeed he owns 120,000 of those June 21st 20 strike call options, it's possible, but that's out of an open interest of 145,000. So that's a huge percentage of that open interest. So you need a rally like this to be able to sell those out, or perhaps exercise them. It depends. I'm sure it's hard to say which he'll choose at this point. But there's an old saying in poker: if you don't know who the sucker is at the table, it's probably you. And you're not in on the inside of this. If you're chasing this stock up here, you're more likely than not the source of liquidity for whoever's controlling this account to sell into your enthusiasm. They're stoking the enthusiasm to get ordinary people to buy, and then they can sell into it. I can't imagine if you looked at this account, if they would even show it tomorrow or Wednesday, that it would have anything close to the long positions it would have today, because they would be nuts not to take profits into a rally of this magnitude.
Steve, I guess my question to you is more of a regulatory question, and I not necessarily weighing in on what should be done, what shouldn't be done, but this does draw some attention to regulations or lack thereof surrounding social media, and of course, when you compare it maybe to analyst notes that are out on the short and long side as well, you can make the case that it's not too different. But do you think, or will we likely see maybe more scrutiny when it comes to social media posts, especially market-moving ones?
I'm neither a legislator or a lawyer, so I'm going to have to say I don't know. I doubt it, because it's hard enough to get lawmakers to agree on pretty much anything. In terms of should they? Yeah, probably. As someone who works for a registered firm, I have very strict rules and regulations about what I can say and what's perceived as manipulative, that sort of thing. In terms of social media, it's not. Now, I will say here, whoever's doing this is actually very clever, because they really haven't been, overtly touting the stock. I mean, the original meme was, a guy leaning forward in a chair. This is just posting a position and showing an Uno card. Obviously, this one's a bit more obvious because the Uno card's a reversal, but none of it is specifically, touting the stock. So from a regulatory point of view, it's murky. But I do think that, it's not a level playing field, because, on social media, if you get enough of a following and are not actually registered with all the various, multi-letter authorities, you're much less fettered to say things than you are if you're in a position where you're subject to having FINRA or the NISD come in and audit you.
Steve, I think you mentioned something very key as well, and it's a decision that a lot of traders or investors are really weighing to begin this week's trading session. Do I chase GME just because Roaring Kitty posted something, or do I chase Nvidia or some of the chip names out of Computex, and Nvidia specifically ahead of a 10-for-1 stock split that happens next Monday?
Well, Brian, chase is always not necessarily the best word for me.
Sure.
In the case of Nvidia, you are buying into a certain amount of froth here, especially revolving around the 10-for-1 split, and I do get a bit nervous that may be a buy the rumor, sell the news type of event. But ultimately, the thesis is there, so you could treat that as, at least you can analyze this as a normal situation and say, okay, it may be getting a little extended, but there's the earnings are this, the expectations are that. GameStop has none of that. It's not. It was overvalued at 20 on Friday, and it's overvalued at 40. It's double as overvalued at 40 today. So I think in general, chasing is a terrible strategy, because you're not in control of the situation. You are just, it's where momentum trading sort of morphs into the greater fool theory. And I think we have to be very careful of that. I actually wrote a piece more or less entitled with that title last week. And I do wonder that, if you're the one buying GameStop simply because you saw something on Reddit, that's one of those where I think you are engaging in a fairly dangerous chase. Mm-hmm. If you're trying to do some analysis on a stock, it may be extended, et cetera, but at least there's something there. And but even there, I don't want to see people caught up in enthusiasm. I tend to be more of a buy the dip person than a chase the rally type of person.
Makes a lot of sense. Heck of a lot of sense when you got the stock up just around 70% right now ahead of the open. Steve Sosnick, always great to get your insight. Thanks so much for talking to us here this morning.
Thank you, Shauna. Take care.
Well, the chips war is heating up once again. This time, AMD and Nvidia both pushing higher after announcing new next-generation AI chips over the weekend. Nvidia's CEO Jensen Huang touting a new chip called Rubin, which he expects to release in 2026. AMD announcing a next-generation AI chip for laptops, with its CEO Lisa Su saying that AI is the company's, quote, #1 priority. For more on what this means for the space and some of those investment opportunities, we want to bring in Beth Kindig, IO, a fund lead tech analyst. Beth, it's good to talk to you here. So first, when we see some of this excitement once again playing out in early market action here this morning, both AMD and Nvidia shares pushing to the upside. What do you make of the announcements that we got this weekend, and where it really tells us about the fact that we're still, it sounds like, very early within the cycle?
Yes, early in the cycle is a great way of putting it. Thanks for having me on. Basically, a couple weeks ago, we had written that in a Forbes analysis that the product roadmap is the first line of defense. It's really important to understand that by speeding up the product release cycle from 2 years to 1, that companies that were previously very cyclical, you had to be very careful about your timing, are now becoming more secular. So in this AI battle, this AI competition between AMD and Nvidia, what we're seeing is something that has never been done before at the data center level. They're basically going to be releasing these every year. As you said, there's Blackwell by the end of this year, Blackwell Ultra, Rubin, Rubin Ultra. And within that, there's additional variations. Within Blackwell, there's a B100, a B200, a GB200, NVL72. So within even that product release cycle of every year, there's additional variations that are coming out. What that means for investors to understand is that previously cyclical companies are becoming more secular. And then when you add on the software layer, that's really going to drive home secular gains.
Yeah, and that certainly mirrors kind of the tone that we heard at Computex from the Nvidia CEO Jensen Huang, where he was talking about accelerating everything. And so how does a mindset and an operation of accelerate everything translate through to market cap and valuation for the company from your perspective, and really kind of ramp up where this could continue to move towards in this astronomical growth we've continued to see?
We have a $10 trillion market cap target for NVIDIA by 2030, and I will be candid and tell you I think it's too low. The reason is that already we see right now about 60,000 GPUs in the data center. Jensen Huang said on stage that we will go toward a 1 million GPU data center at some point. So 10 trillion could even be too low, and here's why. One generation, which is Hopper, gave us a 1.5 trillion push. So now we have 4 additional generations that they've laid out for you over the next 4 to 5 years. Now you got to add on software, and you have to add on something like the Omniverse platform, which is how all robotics, likely a near monopoly of robotics, will be developed, because they're the simulation company coming from gaming roots. They basically have an engine and a software platform that will allow robotics that is so far ahead that other companies are going to have a hard time competing. And that comes from simulation roots already. So when you combine, now you have software to think of, you have automotive to think of, you have robotics to think of, and that's already pushing us easily past 10 trillion by 2030. Of course,
and Beth, just quickly, on what kind of market share are we talking here? Because I mean, there is a competitive landscape where we got to imagine that none of the other chip companies are just going to fall in a ditch.
I estimate that AMD is capable of taking somewhere between 10% to maximum 20% of the market. This is based on the gaming competition these two companies have had for some time. Intel, they are moving well past 20%. Intel is an easier competitor than Nvidia. I think Nvidia clearly is going to be a tougher competitor for AMD. So I would say 10 to 20% AMD on GPUs.
When you take a look, Beth, at least at Nvidia's valuation right now, the massive run-up that we've seen, in the near term, do you see, I know you're seeing obviously a huge opportunity here over the next several years, but in the near term, do you see any sort of the fact that the valuation could be stretched at all?
That is probably the most important question, which is not where will NVIDIA be in 2030, but are we buying now? And it's not actually a valuation concern because we're talking a company that has gone up, 600-700% on the bottom line. So valuation actually is quite reasonable because of all these raises and beats. What Nvidia is going to need is broad market participation. And if you look at the broad market, things are a bit weak. So the best time to buy a stock, in our opinion, is when broad market is participating, which means can Nvidia hold off on a broad market sell-off? Can it sustain? And that's the question that tech investors need to understand, is that at times it has nothing to do with the stock. It has nothing to do with the individual management team or these amazing fundamentals or the valuation, which we are calling eerily low. What it has to do with is broad market and sentiment.
All right, Beth Kinde, great to have you. We look forward to hopefully having you back here on Yahoo Finance again soon. IO Fund lead tech analyst. Thanks so much, Beth.
Thank you.
OPEC Plus agreeing to extend most of its production cuts into 2025 in a move to support oil prices. The country is also extending additional voluntary cuts of 2.2 million barrels per day until the end of September of this year. Ines Ferré standing by with more details on that for us. Hey, Ines.
Hey, Shauna. Yeah, and OPEC Plus put out a very detailed plan regarding its production cuts. Now, keep in mind that most market watchers had expected its production cuts to be extended through the end of this year. So basically what the Oil Alliance has said is that it is going to extend its general production cuts, its official crude cuts, into 2025. And then there are voluntary cuts, which are about 2.2 million barrels of output cuts, that those would be extended in the third quarter. But then they would start to phase out on a month-by-month basis into next year. So they would be restoring these barrels going into the market. Now, what have oil prices done because of this? Well, they have kind of been very choppy over the last 24 hours or so. Goldman Sachs is saying that this decision is going to be bearish given the recent increase in inventories when it comes to oil. Third Bridge is saying, look, unless you see an upside in demand, lifting prior cuts is going to be premature for the markets. And then you have JP Morgan that is saying that this is going to be market neutral. JP Morgan is seeing bullishness going into the third quarter for demand, largely because of bullishness in demand in the third quarter of this year, but then that you may see demand soften in 2025. And this is really the tricky balance that OPEC Plus has had to do, is just balancing this demand and supply in the markets. And given the expectations for demand going into next year, and also given the spare capacity of some of these OPEC Plus members, and OPEC Plus members that don't want to be losing market share to the U.S. and others, which is what they have seen over the last year, guys.
All right, Ines, thanks so much for breaking that story down for us. We're just getting started here on the Morning Brief. Coming up, Paramount shares are rising after Skydance reportedly revising its deal. We've got the details on that report next. And Ford CEO Jim Farley telling Yahoo Finance's Brian Sazzi there's, quote, mutual respect with Elon Musk. We'll bring you more from that interview later this hour. Plus, the meme rally, well, certainly is surging on this morning. We're going to break down what this means for the broader markets. That's coming up in the 10 a.m. hour of Catalyst. We've got much more over the next couple of hours here on Yahoo Finance. We'll be right back.
Let's take a look at some trending tickers here this morning. Shares of GSK, they're plunging after a court ruling stating the drug maker must face trials over claims that its heartburn medication, Zantac, causes cancer. You're taking a look at shares down about 8% here on this news, despite year to date, the company being up by about 19%, at least here in 2024, and over the past 52 weeks being up by about 30%. This could mean a potential hit financially. Ultimately, we'll see what the proceedings look like here and where the ultimate damages could net out at for GSK here.
Yeah, exactly. I think that's a big question at this point here. We are looking at shares under a bit of pressure here, at least in the early action. You're looking at where it closed on Friday and that 1 year gain that we've seen of just over 30%. But again, when it comes to this ruling, exactly what this means here for the company going forward, lots of questions here. Shares are off just around 8%. So off the lows of the morning, have been off just over 10% shortly after this news broke. But again, this is a stock that Wall Street, there's 10 holds on this right now, only 3 sell ratings compared to 15 buys. So many are still optimistic just about some of the longer term trends that we'll see from GSK. But obviously, when you see a move to this extent here, like we're seeing today, there are some concerns, at least in the short term, what exactly this is going to mean for GlaxoSmithKline's business.
Yeah, GSK expected to appeal, and also they had put out a statement saying that the epidemiological studies, got that one right.
I'm impressed.
Looking at human data regarding the use of ranitidine, can't get them all. The scientific consensus is that there's no consistent or reliable evidence that it increases the risk of any cancer. We'll see how much that defense holds up.
You're a doctor here.
You know, I mean, just call me Smith MD.
Moonlighting.
Why not?
All right, let's talk about Paramount. Shares are moving higher after Skydance Media and Paramount have reportedly agreed on merger terms. This is according to a report out from CNBC. Yahoo Finance's Alexandra Canal has the details. Allie.
Hey, Shauna. Yes, according to that CNBC report, a Skydance and Paramount deal is expected to be announced in the coming days with an equity check that totals $8 billion. Now, leading up to today, we've heard previous reports of a sweetened deal offer from Skydance, and now the details of that offer are coming to light. According to the Journal and now CNBC, the new deal allows Paramount's non-voting shareholders to cash out at a premium of around $15 a share, while also giving shareholders the option to roll out into the new deal. Now, based on Friday's closing levels, that represents about a 26% premium, although shares, as you're seeing, are up about 8% in pre-market trading this morning. Now, it's still possible that deal negotiations could fall apart, as the Skydance offer is a bit complicated. It would involve Skydance purchasing a majority stake in National Amusements. This is the holding company that controls Paramount and is headed by Shari Redstone. Once that happens, Skydance would then merge its studio business with Paramount. So a bit of a two-step deal there. The Journal added that Skydance plans to inject at least $1.5 billion into Paramount's balance sheet to help pare down some of its debt. Last week, an independent committee reportedly gave the thumbs up to the revised deal. But again, still the possibility that the company could potentially seek out other offers or require approval from non-voting shareholders in order to go forward with the transaction. So by and large, still up in the air, but it seems like it's more and more likely that Paramount will be sold. Shares again up about 8%.
All right, Allie, thanks so much. A lot to continue to track around Paramount going into the start of today's trading activity. Speaking of which, we're about 40 seconds off from the first trading session here in June. I'm excited. You're excited. My gosh, look at the futures. They're excited too. The Dow, the least of the excited though, flat just barely to the upside. S&P 500 and NASDAQ, fractional gains there coming into the start of the trade. I just learned that you have to say rabbit
yes.
on the first of months now. You educated me on that. I'm learning so much this morning. I'm learning about NIM, Nvidia NIM. It's the inference microservices. They talked about it, Computex.
We can go on and on. And it's only 9:29. We're not even at the opening bell. And it's the wealth of knowledge here this morning.
I still got 30 more minutes of learning to do during the show.
You do.
It's going to be
we're
incredible,
just bringing
folks.
it all to you guys. And as we take a look, the opening bell here on Wall Street, you've got Skechers at the New York Stock Exchange kicking off this first trading day of June.
That's a good one. Kicking it off with Skechers. Okay.
Off to the races.
Oh, yeah. Man, NASDAQ, not to be outdone, releases funfetti immediately upon hearing Shauna say Skechers kicking things off. And there you're taking a look at both opening bells there. I was trying to figure out who was up there with Skechers, because it seems like there's always with the footwear companies somebody who's up on the podium with them, given some of the sponsorships that they have. I can't really zero in on, I can't see it, but Anyway, no doubt, great bunch of folks that's up there beginning today's trading activity here on the day. There you're taking a look at some of the averages out of the gate here. We've got some green across the screen for the opening cross.
We certainly do. When you take a look at some of that sector action, you've got chip stocks leading the way. That's pushing technology higher here. Big reason why you're looking at the NASDAQ leading the charge as we wait for it to calibrate just a little bit here, but leading the charge at least at the open as opening trades shake out over the next several minutes. But again, you got the Dow just above the flat line. You've also got the S&P getting closer and closer back to that 5,300 level. All right, let's head over to Jared Blickery standing by, who has a closer look on some of those movers here at the open, Jared.
Yes, let's load up the Wi-Fi Interactive behind me. I'm taking a look at the Dow, and the Dow has been lagging the general market, but not Friday. When I say the general market, I just mean the S&P 500. But this was the very end of the day. We got some of today's action there on that rightmost candle, but we did see a bang into the close, which I haven't seen in quite a while. Now, here's what the NASDAQ is doing today, and you can see up it's gapped a little bit there, but I want to focus on the S&P 500 and compare what we normally look at. This is the market cap weighted index, and here we have these record highs, and we're actually pretty close, not far off from them. But you take a look at the equal weighted, and that's a different method of calculation where everything is equally weighted. Every stock gets one vote, whether it's Apple or Waste Management. And here we see that this peak was not able to exceed the one from earlier in the year. So this is a form of divergence that traders track potentially until it's resolved. You got to think, well, maybe we could go down a little bit from here. Also want to check in on the 10-year T-note yield, that along with the dollar, and I'll throw the VIX in there, and I'll also throw in I'll put those three together. All three of those are down from last week highs, so that's kind of a tailwind for the markets. And real quickly, I just want to take a look at the sector action. Tech is the only outperformer today, but what I've been tracking pretty closely is software versus semis, and I'll give you a look at today. Well, you can see that semiconductors are once again outperforming, and here's the year-to-date where you can see semiconductors really close to those record highs, while software just flagging a bit.
All right, Jared, thanks so much for breaking that down for us. Of course, some trades to keep in mind here as we kick off the first trading day of June. Well, we've got much more of your market action ahead. Keep right here on Yahoo Finance. We'll be right back. You're watching The Morning Brief. Well, chip stocks leading the rally this year, and so far the sector overtaking software and being the heaviest weighted sector in the S&P 500. To break it all down, where you can cash in on that AI hype, we want to bring in Young Yu Ma, BMO Wealth Management U.S. Chief Investment Officer here. Young, it's great to see you again. So let's talk about some of that excitement that we're seeing play out from a broader markets perspective here. When we take a look at the AI trade, it seemed to be losing a bit of steam going back to last week when you saw the reaction to Dell, when we heard about some of the concerns here from Salesforce and the fact that, hey, maybe demand isn't going to be living up to expectations here, at least in the short term. And now here we are Monday morning, and we're seeing that excitement return once again when it comes to the AI trade. What are you seeing just in terms of whether or not you think this rally has legs?
Yeah, thanks, Sean. It's great to be here. We do think it has legs, but we do think the enthusiasm for AI is going to come and go in waves. And when the news and new information comes out that sort of sparks new investor enthusiasm or renewed enthusiasm, it's very difficult to predict. But over the medium term, we do think that the productivity gains and the benefits from AI will be apparent enough that the rally can continue and continue to increase spending in these areas that will help the companies that feed into this. So overall, we're positive on AI, but we do think it's going to be a choppy path forward.
And so all of these things considered, where do you think we'll continue to see overcrowding in certain trades or even some profit taking in the near term?
Yeah, in the very short term, it's a little bit difficult to game. I think that's a tricky play here because there is a lot of enthusiasm that's already baked into some of these AI stocks here. And I do think that the trends for AI are positive in the medium term. But when there's too much froth and when that sort of deflates a little bit and then reflates, it's very difficult to play out here. But we do think the medium term is quite favorable.
And I want to bring up our chart of the day from our morning brief newsletter here this morning. And it's talking about the fact that broadening out that we had seen very briefly earlier this year and also at the end of last year, that's starting to lag just a bit, and especially lagged in May. It's lagged over the last several weeks. When you take a look at that, some out there, some strategists have been saying that, hey, this is a bit worrisome given the calls that we started the year with and the importance here in order to see more of that rotation. Are you at all concerned by some of the patterns that we've been seeing?
It is concerning. It's certainly concerning in the short term that we're seeing a relatively narrow market, and that narrowness has been increasing recently and really driven by fewer stocks. So, that's not what you want to see for market health. We have seen, at least recently, last week as well, a little bit of pickup in the small caps, which was nice to see. So there are a few areas of this we're monitoring, but we don't want to see much more deterioration from here in terms of that breadth of the market and the sort of underlying fundamentals of the rally. So it is concerning, but it's not something that right now would lead us to shy away from the market overall.
As you kind of think and assess the earnings season that we've in large part made through, I mean, there's a couple more retail companies that are going to trickle out over the course of this week and a few B2B companies, CrowdStrike later on this week as well. All of those things considered, looking back at how some of the companies that have missed on earnings have been punished more than the historical averages, and even those that have topped out, they're not getting rewarded to the same extent that we've seen before. What's that set up for the rest of the year as we go through the future earnings cycles?
Yeah, there was just a lot of enthusiasm coming into the earnings season. And as you mentioned, you saw huge punishments for companies that didn't meet or exceed expectations by a sufficient amount. I think it depends when we go into the next earnings cycle, how it plays out going into them. Is there a big enthusiasm ramp up pre-earnings cycle that then the earnings announcements really have to meet and exceed, or do we see some muted expectations going in? So I think it's really about where we started the cycle and then how things play out, and you have to take those two things together. So I think it remains to be seen what the next month or two will be like if we get a renewed bout of enthusiasm that could set us up for very high expectations going into the next earnings cycle.
Is it clear, though, that artificial intelligence can't just be the silver bullet that gets deployed by companies at this juncture?
Well, I think artificial intelligence is going to be a big productivity enhancer over the medium term. But when that actually shows up in the data is going to be quite some time, probably a 2025 story. Is it a silver bullet? It can be a silver bullet, but that's something that plays out over time. That's not going to be a silver bullet over the next month or two. So, we're going to get data, we're going to get information. We saw another announcement by Nvidia recently about the launch of some of its new and enhanced chips. So this data and information is going to come and go in waves, and that's going to create different bouts of enthusiasm in the market. In the medium term, we're very optimistic. In the short term, it's just a lot of choppiness and inflation and deflation that we have to deal with in the markets.
Young-Yu Ma, BMO Wealth Management U.S. Chief Investment Officer. Thanks so much for kicking off the week with us.
Thanks, Brad.
Thanks. Coming up, everyone, Ford CEO Jim Farley telling Yahoo Finance there's, quote, mutual respect with Elon Musk. We'll bring you more from that interview next.
Competition in the auto sector is heating up as the industry transitions to EVs. In an interview on Yahoo Finance's opening bid, Ford CEO Jim Farley laid out his company's future plans. Our very own executive editor Brian Sazi joining us now. Brian, it was a great conversation between you and Jim. So what were your key takeaways from that discussion?
Well, first and foremost, guys, it was Jim Farley's thoughts on EVs. I should note this interview for opening bid took place inside Michigan Central Station, which reopened today. $1 billion investment from the Ford team to refurbish this iconic train station. But it was in there, I asked Farley his views on EVs, a division that might lose close to $5 billion in operating profits this year.
We really believe in the consumer experience for an EV, and so we want the next ones to be more affordable. And that's why we're investing in more affordable EVs in the next cycle of products that people see from Ford in the next couple of years. We're number 2 in EVs in the U.S., behind Tesla, a long way behind, but we're still there. And people love their Mach-E's and Lightnings, and they're going to like the new ones even better. What's hard about it is making the physical changes to be profitable, to bring the cost down.
So Farley, I think, is very focused on getting that division to profits. Now, I pressed him if he has a date on when that EV division might hit profits. Didn't want to share that date. My quick takeaway is maybe it's a few years from now. But nonetheless, you heard Farley mention Tesla. Now, Farley has embraced Tesla and CEO Elon Musk, both publicly on Twitter, but also just operationally as well, working last year or signed a deal with Tesla to get adapters for his electric vehicles so they could be charged at Tesla superchargers. I asked Farley about that relationship and where it stands.
I think it's been largely a positive relationship. You know, in 120 years, we've been through a lot as a company. Like, we know what a partnership should be and what's realistic to expect out of a partner. You know, we compete. I mean, Mach-E and Model Y, they're in the market competing every day. So we're realistic, but so far the partnership has gone well and we have a professional relationship.
It was funny to hear Farley. He also mentioned in the interview that they need 90,000 more adapters from Tesla. And he said he texted Elon the day before this interview. And I asked him, well, did you text him? Did he text you back? I don't know if he texted him back right away, but there is a relationship here between these two titans of the auto industry, and there should be. I mean, this is probably good business for both companies.
Well, yeah, I mean, the North American Charger Standard is what Tesla had been trying to get every automobile manufacturer on. It was their way of cementing their own kind of key cog within the broader engine to the EV landscape as a whole. So I would hope that he got his text back.
I'm sure Elon texted him back. We'll wait for Elon to respond over to us on X. But it's interesting because you hear Farley talk about he's very focused on EV profitability, now adding more hybrids to the mix. GM has taken a little bit of a different tack under CEO Mary Barra. They remain, I think, laser focused on getting these electric vehicles to market at any cost, even if it means losing money. How they've been able to offset those EVs is cutting a lot of costs throughout their organization, buying back a lot of stock. That's why you see GM stock having outperformed the likes of Ford the past year.
All right, Sazi.
Significantly.
Yeah, seriously. Great interview there. You can watch the full interview, Ryan Sazi and Ford CEO Jim Farley, on yahoofinance.com. Well, as we were just discussing, Ford CEO Jim Farley laying out in that interview to Yahoo Finance his plans to make electric vehicles more affordable. Will all the other auto companies follow suit? And what would this mean for the auto space as a whole? Tom Narayan, who's the RBC Capital Markets Global Autos Analyst, joins us now. Tom, great to see you here this morning, and thanks for jumping on with us on Yahoo Finance. Let's start there. I mean, if we did see a more affordable electric vehicle from Ford, what would the rest of the industry be prompted to do?
Yeah, I think this is actually where the industry is headed. You know, a lot of folks focus on charging infrastructure as the real hurdle for EV adoption. It's not. It's really pricing. We have enough charging infrastructure, actually. And the pricing is just too high right now, especially all the early adopters that kind of gobbled up the expensive EVs. Now we're in the mainstream consumer, right? This is where you have the cold culture wars issue. So once pricing comes down, we think the whole industry will follow suit. But a big driver of that, as Jim Farley said in your guys' interview, was battery pricing needs to come down. And guess what? It is. Those raw materials have come down a lot. And I think that's why you're going to see a lot of lower priced EVs hitting the market in as early as 2025.
How much lower, Tom, when it comes to pricing? I guess what's that key critical level that these vehicles need to get under in order to see that mass adoption?
Yeah, that's a great question. I mean, I think it has to be at the same price pretty much as an ICE car, right? So, you know, the average price e-cars, though, have gone up quite a bit, right? So they're almost like, you know, $40,000 in the United States. You know, an EV is probably more like 50 to 60. When you get the IRA credits, which is $7,500 off that, maybe the battery prices come down. If you can get them in that $30,000 to $40,000 range, I think they get more interesting. And you definitely have that push, right, to get the $20,000 to $30,000 EV. That will come. It'll be a little difficult to get there. I mean, Chinese already have that in Europe and in China. But in the United States, I would say that $30,000 to $40,000 range when you include everything together.
Tom, when it comes to what's next here for this Model E division, what exactly the uptake rate is going to look like? Sazi asked Jim Farley about profitability, that timeline there. And Jim Farley declined to really give a timeline, but I'm curious from your perspective, from an analyst perspective, is this something that you think is a couple years out, or what do you think is realistic?
Now, this is the real big question for Ford, right? Because their other business units, especially Pro, is amazing. And so this business is losing, what, $5 billion a year. I think folks are more looking at the inflection, meaning lower losses. We didn't really see that in Q1 results because the units that they sold were too low. So people want to see more of an inflection where losses are declining. I don't know if folks are really saying, when are we going to get break even or profitability? It probably could be a couple of years to get to break even. Certainly, profitability. It's unclear. The EV slowdown really has impaired things. They thought, I think, they were going to get contribution margin positivity by the end of 2024. That may be slipping a little. So there's a lot of variables that are there. I think folks really want to know the inflection of losses stopping, as opposed to when are we going to get to break even.
And with that in mind, Tom, how much does the network also need to improve for charging? Because, I mean, that is the common thought. What is the mileage? What's the range that I get in comparison to the ICE engines that we were talking about earlier?
Yeah, we've done a lot of work on this using we have an internal data science team called RBC Elements that looked at all the charging infrastructure in the U.S. And looked at like how many EVs are there on the road, how many charging points compared it to ICE cars and petrol pumps. Actually, the infrastructure is quite good because there's just not that many EVs on the road. So it's more of a psychological issue for people who are just scared. They have range anxiety. And that's not going to go away. It's just unfortunate reality. We do need to build the infrastructure out, but that's really not the real problem. It's just a psychological problem. The real reason is the pricing. The pricing needs to come down. EVs are too expensive. We also need more models that fit to what Americans want, right? They want SUVs. And right now, SUVs that are EVs have very little range because they're unaerodynamic and they're really heavy. So you need a bigger battery, and that costs money. So battery prices need to come down. And we need more SUVs, maybe pickups, stuff that Americans want, right? All we have in the EVs right now are like crossovers and some sedans. And so we need the form factor to change and the pricing to come down.
I'd be just fine with a live wire motorcycle, Tom, and maybe a little sidecar for the golf clubs or for whatever else I need to throw in to that. Tom, thanks so much for taking the time here with us today. Tom Narayan, who is the RBC Capital Markets Global Autos Analyst. Great to see you.
Sure.
Coming up, airlines are expected to reach almost $1 trillion in revenue this year, but how's the profit margin on that? We'll give you the details when we come back. You're watching Yahoo Finance. Airlines are expected to bring in $996 billion in revenue this year. That's according to the International Air Transport Association. But with all that revenue coming in, the profit margins remain thin, with an expected year-end profit of $30 billion. That's up from the previous estimate of $25.7 billion, or just $6.14 per passenger. So ultimately, we're taking a look at some of these figures and the year over year, the return on invested capital in 2024 as well. That was an interesting figure to me. It's expected to be 5.7%. That's below the average cost of capital as well. And the operating profits, even though they're supposed to be up, we're going to reach $59.9 billion is what they're anticipating. That compared to what we saw last year, $52.2 billion, which, if you remember, 2023 was the first year that we surpassed some of those pre-pandemic markers for traveler, at least passenger throughput via TSA.
Yeah, and I think when you take a look at the regional basis and some of those expectations there, that's also interesting. When you take a look at the outperformance when it comes to North America, they're expected to be the biggest contributor here to industry profits for this year, and comparing that to Europe, that's going to contribute about $9 billion compared to North America, which is just shy of $15 billion. And then following Europe is the Middle East. Notice I didn't say Asia. When we talk about some of the underperformance there, a lot of that being attributed to China, and some of that weakness there being holding back the recovery within that region. So Asia demand remaining subdued yet again, still expected to be below those pre-COVID levels. So a bit different when you compare it to some of the trends in demand that we're seeing elsewhere around the world.
Yeah, slowing growth, youth unemployment, and the relative strength of the service sector, they mention, are some of the risks that should be closely watched there.
All right, let's take a look. We're going to switch gears here in industries. We're going to take a look at a trending ticker, and that's Boston Beer. Shares are plunging after Suntory denying that it would be making an offer to purchase the beverage giant. Now, the company telling Yahoo Finance, quote, "There is no fact that we are in any negotiations with Boston Beer," and you can see that reflected in the stock price this morning, under a bit of pressure. And remember that this comes after the stock shot higher on Friday following the report that was initially reported here from the Journal. When it comes to analyst reaction and what the quick take was, Bernstein was out saying that the deal might actually look good on paper, but a transaction is not devoid of challenges, talking about limited synergies, which I think was one of our first questions here. Outside some of those one-off brands, when it comes to a Twisted Tea, they do have limited synergies. So I think when you talk about some of the projections there, what exactly that could look like is one of the questions here for analysts. But again, giving back some of the gains that we saw on Friday on the heels of the fact that they're saying that actually they're not in talks to acquire the company.
Yeah, absolutely. This is one of the companies we're going to be watching over the course of this week as well. You do have some earnings that are going to be coming out this week from this industry, and I think notably Beam Suntory is supposed to be reporting earnings this week as well. Brown-Forman is reporting earnings. So, all right, anyway, we'll be tracking the liquor space.
We will be tracking the liquor space on this Monday morning. All right, well, coming up next, we've got some breaking manufacturing data right at the top of the 10 a.m. hour. We're going to dive into what exactly this means for the Fed and for the markets. Plus, our very own Brian Zazi sitting down with Marriott, the CEO, to discuss the state of luxury travel. We've got all that and more on Catalyst next. 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst moving markets today.
Stocks are mixed ahead of a packed week of economic data, starting with those manufacturing prints coming out right now. We're going to get to that, plus a slew of key readings on the jobs market to come throughout this week. We're going to tell you what that data could mean for markets.
All right, and the meme stocks are rallying. Another social media post, a link to the meme trade superstar Keith Gill, sparking a surge in GameStop shares. We're going to discuss what this tells us about liquidity in the market.
And OPEC Plus agrees to extend production cuts into next year, this sparking debate over the outlook for the oil market. We're going to dive into concerns around supply and demand for the energy sector.
All right, let's get to some breaking news that we have out here this morning, and that is the latest data coming out in the manufacturing index. The ISM manufacturing falling to 48.7%. That's coming in below expectations. When you dig into this report, some of the key tidbits that we want to highlight here, you've got prices paid that actually fell from 60.9 the previous month to 57 flat. When you take a look at some of those other tidbits here, inventories falling to 47.9, but employment rising to 51.1. Now that is actually the highest level that we've seen since August of 2022. And Maddie, when you take a look at some of the reaction that we're seeing play out in the market now.
Yeah, it's interesting to see some of the moves, particularly when you look at the bond market. We're seeing that yields are plunging off of this data. I want to take a quick look at some of the actual moves that we're seeing. In the 5-year, you're seeing that coming in at around 4.4. In the 2-year, you're seeing that coming in around 4.8. I'm also seeing the movement in the 10-year hitting a little bit below that 4.4 mark here. So seeing a lot of movement there. We're also seeing movement in the dollar, some softness there coming in off of this ISM data, missing the estimates that we're seeing. We're not seeing a lot of reaction when it comes to the stock market, not too much reaction there. So it could mean that we're seeing some movement, particularly in tech and utilities, kind of boosting the overall market here. Seeing the S&P coming off just a bit from its highs, but not a ton of movement there, Shauna.
Yeah, certainly. Again, it's going to be interesting tidbits to watch here just in terms of the impact that this is going to have. Obviously, this is the first read, so as traders digest, we'll see whether or not this initial reaction holds here throughout today's trading day.
And as I mentioned, stocks are mixed as that manufacturing data showing some growth in the latest readings. This comes as PCE inflation rose at a slower rate in April, but this data potentially reigniting hopes that the Fed could cut rates this year. Joining us now to discuss, we've got Peter Garnery. He is Chief Global Equity Strategist at Saxo Bank. Peter, thanks so much for being here. I know you're just getting in this data as well, but what is your initial reaction about what this could mean for equities moving forward?
Well, I think that it confirms that the manufacturing sector is just hobbling along, around slight expansion. In this case, there's some bits here that are contracting, but we are facing a world where China is pushing on an export string, and that's really pressuring manufacturing, both in Europe and the US. And one of our main theses is actually that the harder China is pushing on this export policy that they're pursuing with very heavy government subsidies, the harder the pushback will be from the US and Europe. So in the short run, it could cause lower goods inflation in the global economy, but longer run, the goods inflation will be higher because it will force the US and Europe to be more protectionist trade policies and put up tariffs around their economies, and also reshore manufacturing, maybe to friendly countries, but maybe even within the US and Europe, and that could push goods inflation up. But I would also say that for us, the main thrust in the economy, both in the US and Europe right now, is the services sector, and that's also the potential cause for these inflation dynamics to persist for longer than expected. The labor markets are still tighter in the US and Europe than they were prior to the pandemic, and wage growth, it's coming down, but it's still pretty high. And I think when you sum it all up, I think our equity outlook is still positive, and it's driven by the services sector, which is the dominant part of the economy.
So your outlook's positive here, but Peter, what do you think gains are going to potentially look like, and how much of it, when we talk about that catalyst here for future growth, how much of that is dependent on that first rate cut?
I think so this is where it's getting really interesting. I think we have an economy right now that can best be described as a two-lane economy. You have a part of the economy that is interest rate sensitive, consumers that need short-term refinancing on consumer credit, high yield financing, corporations, etc., car manufacturers. That part needs potentially lower interest rates, but then you have AI-related, the technology part of the sector, healthcare, pharmaceutical, obesity drug manufacturing, that part of the economy is powering on. So that's the conundrum that the central banks are facing, because inflation is not where they want it to be, and you have this two-lane economy. I think the rate cuts, we'll get one from the ECB here on Thursday. Then the big question is whether they will pursue more rate cuts. I think it's pretty doubtful, because the growth is coming back in Europe. In the US, I think the rate cut will come later this year. In the short run, I think that we can best be described as an environment of low inflation. The outlook for companies look pretty stable. And there's so much fiscal deficit and fiscal impulse coming into the US economy, and it's also being cranked up here in Europe because of increased military spending due to the war in Ukraine. All of these things point to a positive outlook, and I think we need to get on the other side of the US election in November to really see the next pivot in markets and in sentiment.
How big a role do you think the election will have in when the Fed decides to cut rates?
Well, I think what plays out, the biggest potential fragility to the US economy is that the government has played a huge role in this enormous growth that is ushering over the US society or the US economy because of that fiscal impulse. That is unsustainable in the long run. And I think it has been addressed and mentioned by many people in the States, but also here in Europe, that we need to address the fiscal situation, and it will not happen on this side of the US election. So the US election will be quite crucial. There will be obviously details depending on whether it's Trump or Biden that wins the election. I think a lot of the things are still set in stone in the US, their relationship and the frictions that they see towards the Chinese economy. But yeah, I think it's too early to speculate. We'll have to see what happens after the election.
All right, Peter Garnery, thanks so much for taking the time to join us here this morning. Saxo Bank, a chief global equity strategist. All right, let's turn to a big story that we are tracking here this morning. That's the rally that we're seeing in meme stocks. You have GameStop. Shares are surging after a Reddit account linked to the meme trade influencer Keith Gill posted a screenshot showing a massive stake in the company. We could not verify the post here, but GameStop sparking a surge in other meme stock names. You can see that excitement on the screen right now, though GameStop well off the highs that we saw pre-market here, so pairing some of those earlier gains even after the opening trade. It was halted earlier due to volatility. So what does this tell us about what the action we could see in the broader markets? We want to bring in James Gellert. He's Rapid Ratings International CEO and Executive Chair. James, it's good to see you here. So let's talk about this excitement that we're seeing back once again within the markets, all being driven by this post that we think is from Keith Gill over at Reddit, the account linked to Keith Gill in the past. What does this tell you just about the current investor sentiment right now, and whether or not this type of behavior is here to stay when you get someone like Keith Gill posting about that opportunity that he at least sees in GameStop?
Well, I think it indicates we're in a frothier market again. When we have a frothy market, when we have a lot of exuberance, there are momentum players, particularly from the retail side, that are prepared to come in and throw money. In some cases, it's new money that they're investing. In some cases, it's gains from other places that they have made bets over the last year to a few years. But you don't see this kind of a reaction unless there is real excitement and exuberance going on. Otherwise, you just can't see the jumps in stock price in a company like this that still has a lot of fundamental issues to solve, unless there's just a ton of eagerness in a group of investors to be involved kind of at any price.
Well, given that, I want to get your take on what we're seeing today versus what we saw in 2020. We spoke with Wedbush analyst Michael Pachter about what Roaring Kitty's 2020 move on GME meant and why it sort of made sense at the time. Take a listen to what he had to say.
More than 100% of the shares short, and he made that observation. It was astute. He rallied retail investors, Redditors, Reddit raters to buy into the stock.
So he's talking about that 2020 move sort of making sense given what he was seeing in the shares, this astute observation here. Given what you just heard, compared with what we're seeing today, are investors more likely to lose this time around?
Well, I think a lot of investors have lost pretty consistently along the way. And when you take a company like GameStop that has capitalized, you can argue well and appropriately or inappropriately, but a company that capitalizes on this kind of momentum by issuing new stock is fundamentally diluting the holdings of everyone who has invested to date. So when GameStop issued at the market equity just a few weeks ago, they were effectively diluting the value of each share that each holder had prior. So irrespective of what the share price was, there were more shares, and therefore everyone held a little bit less. So you've got this phenomenon going on as well. In almost each one of the rallies that we've seen, they are coming off. We're not holding the highs. Even today, we haven't held the highs on GameStop. No one wins without someone else losing in a case like this. So there are definitely people with axes for momentum, and they are pushing the stock, and a lot of people are jumping in, but not everyone is getting out at a time when they can make a profit.
James, and I know you've dug into just the fundamentals of this, has anything changed in that part of the story when it comes to GameStop?
Well, so the financial health rating at Rapid Ratings is entirely empirical. We look just at the financial statements of companies and analyze the companies against millions of company years that have come prior across industries. And with GameStop, we see them now rated at a 50 on a 100-point scale. So it is right in the middle of our medium risk territory. That's the short-term risk, the financial health rating. The core health score is currently rated at 26. The core health score looks out multiple years at how fundamentally strong or weak a company is. So what you've seen with GameStop over the last few years is a minor uptick in the financial health rating, but actually a decline in the core health score. And for any company that looks like this, what that's essentially saying is that the fundamentals of the business are not improving or slightly deteriorating, but the liquidity of the business is propping it up in the short term. And that's what you see mirrored in the fact that they are able to periodically raise more equity and therefore cash. They don't have a lot of debt. That speaks well for them. They have been paring their losses. That speaks well for them. They still haven't been profitable in about 5 years. That doesn't speak well for them. So the real question here from a fundamentals perspective is, does GameStop have a plan? And is the plan one that they can sell to a more sophisticated, consistent institutional audience, not the momentum retail players? Because that plan needs to show that the company is on track to be better at some point in the future when liquidity isn't quite as easy to get and when that fuse life actually burns out.
Taking a step back, James, I wonder, if you look at the Yahoo Finance trending tickers platform right now, you can see that BlackBerry is trending far above even a name like Nvidia. And it makes me wonder if there is an opportunity here for investors to sort of get an edge with some of the memeier names in the space when you've got a big tech powerhouse like Nvidia that one could argue is already getting a lot of attention and has higher valuations. Is there an opportunity for a potential edge on these meme names?
Well, there's an opportunity, but you have to question what the opportunity risk ratio is. And there's no question that people can make money in these stocks because they're moving so much in a short period of time. The question really is, are they prepared to take the risks of losing a significant amount of principal in the case that the volatility turns against them? And that's what we've seen time after time. But there's definitely upward movement in each one of these, but people have to be prepared to be in and be out. And certainly no one, Gil or anyone else, is touting a position and saying, I'm holding this position for 5 years, or some longer term period that would suggest a buy and hold strategy. Everything that is around the meme stocks is about getting in and getting out, or squeezing shorts, or doing something that is a shorter term activity. Even the options position that I believe he posted, or is attributed to him, posted in the last 24 hours is a relatively short term contract. So it needs to have momentum in order to be in the money and to be sold, which is undoubtedly a real reason why someone would want to inject more momentum in. If you want to ride along for the gains that you may get in that process, I think that's a totally reasonable thing to do, as long as it's done with a conscious understanding that the potential to lose money is significant.
All right, James Geller, Rapid Ratings International CEO and Executive Chair. Thanks so much for jumping on with us here this morning. Want to turn to oil. Lower this morning. Brent crude briefly trading just below. It's still right above $80 a barrel here. You've got crude also off just around 2.5%. We're seeing this reaction after OPEC Plus agreed to extend group-wide production cuts into next year as it attempts to support prices. Joining us now from the outlook of the crude markets, we want to bring in Bob McNally. He is the founder and president of Rapidan Energy. It's good to have you, Bob. So let's talk about some of that the market reaction that we're seeing here in the oil markets. You're looking at this, it almost seems like the street at least is looking at this from a bearish perspective. Is that the right reading?
You know, good to be with you. I don't think so, but you know what? Reasonable people can differ. Yesterday's decision had a lot of moving parts. Some of them were supportive of price, like extending 3.7 million barrels a day of cuts that would have expired in December 24 through 25. So that was unambiguously bullish. But they also came out and said, look, here's our schedule for tapering about 2.2 million barrels a day of cuts that were extended from June till October. So the appearance of a detailed monthly tapering schedule over 12 months, that I think caught folks by surprise and has the bears thinking, uh-oh, they're going to be adding back barrels. In my view, OPEC is willing and able to pause or reverse any tapering. I don't think they're going to let the bottom out of this price of crude, but it's understandable why some folks are taking it bearishly today.
So what would you say to those folks in terms of your number that you think that we're going to get in terms of per barrel moving forward? And what do you think the biggest catalyst for that is going to be?
So, you know, we're telling clients we're in a range. We're in an $85, $90 average Brent range. The downside risk and the pressure on the markets clearly from macro. You know, everybody has to be a Fed watcher these days. Huge macro risks on demand. Demand has not been great this year. You just saw the PMI came out. Diesel demand, which is the economic fuel, not good. China, weak. This is why OPEC Plus had to extend these cuts. So look, there's real downside risk and pressure on the price of oil, mainly from macroeconomic conditions. And your upside risk is mainly from geopolitics in the near term. So far, the market has shrugged off disruption risks, whether it's Ukraine or Israel, Iran related. I still think there's risk, particularly with regard to Israel and Iran. But for now, the market's in show me the barrels mode. So I think we're range bound with macro pushing prices down and geopolitics posing some latent bullish risk.
Bob, why do you think the geopolitical risk has been shrugged off, what you were just saying? And I guess what is going to then be the differentiating factor for the market to react to some sort of development?
You know, traders are in a boy who cried wolf mode, right? In 2019, Iran attacked Saudi Arabia, massive disruption, largest ever open on a Sunday for crude oil, but didn't last that long. Then when Russia invaded Ukraine, everyone thought we're going to lose Russia. We roofed, we saw record gasoline prices in the United States, didn't have a disruption in Russian oil. And Iran's been hitting boats and ships from time to time without any lasting disruption. So the market, I think, is like, you know, I'm just not going to believe it until I see it. And even when Israel and Iran traded blows, direct attacks recently, again, those did not escalate into a material disruption of Arabian Gulf flows. Finally, Red Sea. Yeah, it's bad. No LNG is moving through the Red Sea, but the market is optimized. We're diverting around it. After all, the Red Sea is just a shortcut, and you can avoid a shortcut.
Bob, you were the former White House energy advisor. You've said that rising oil prices are understandably an existential crisis for politicians. If you were in that role today, and given that President Biden is also in the middle of an election cycle, what would you be advising him?
Well, you know what I learned in the White House, and I would advise any president, is the biggest thing you can do is not make mistakes. And one mistake would be to spill more strategic petroleum reserve barrels. That's just a bad idea. I commend the Biden administration for trying to refill the SPR, which they're doing. That's the right thing to do. Don't take the bait and use the SPR to try and control gasoline prices, as the president has done, unfortunately. Second, he's going to be getting a lot of bad advice if oil prices go up. That includes to restrict exports of refined products. Like we export a lot of gasoline and diesel, including to our allies and friends. Some protectionists will say, hey, let's cut off those exports and keep them at home. Really bad idea. You'll get about 2 days of relief at the pump, and then we'll be worse off because you'll have less investment and higher prices. So avoid mistakes. That's my main advice.
All right, Bob McNally, Rapidan Energy founder and president. Thanks so much, Bob.
Thank you.
We want to get to some breaking news. The New York Stock Exchange investigating a reported technical issue. It's impacting some stock prices. We're seeing massive moves in a number of stocks here this morning. Now that trading was halted for a number of those names. Looks like New York Stock Exchange is investigating that, and we will bring you any update that we get. All right, coming up next here on Catalyst, we've got much more of your market action ahead. Our executive editor, Brian Sazi, sitting down with the CEO of Marriott. They're going to discuss all things travel next.
Consumers are still spending, especially on travel. Marriott is expanding its luxury hotel portfolio with 3 new locations in the U.S. I have Anthony Capuano, Marriott CEO, with me in our Yahoo Finance New York studio. Anthony, always good to see you.
Good to be back.
So talk to us. Let's start on the demand for leisure travel. What are you seeing from consumers? I think coming out of your most recent quarter, things may have slowed down a little bit, but what are you seeing now?
Yeah, I mean, a little bit, but what was encouraging to me when I looked at the data in the first quarter, not only did we have continued strength across geographies, but across segments. Group continued to be the standout. RevPAR was up about 6% in the quarter, but leisure was still up 4%, and that's building on historic highs. So we continue to see strength in leisure. And then when we look into the summer leisure season, we're up a couple points on forward bookings for 4th of July here at home.
Is that U.S.? That's U.S.
That's U.S. But then when you look at outbound into especially Western Europe, France, Italy, Spain, Greece, last summer was a record summer, and we're up 7% on forward bookings.
How do you explain, we just heard some really bullish indicators, too, from some of the airlines coming out here with good results. How do you explain this continued strength in travel in the U.S.?
Well, I think even prior to the pandemic, with some of the younger demographics, you saw this spending shift away from consumption of hard goods towards experiences. And it certainly appears when we look at that credit card spend data that the pandemic acted as an accelerant for that trend across demographics. If I play amateur sociologist, I think people during the pandemic recognized, I haven't bought another watch or pair of shoes or handbags, and that's okay, but I sure miss travel, and I'm going to prioritize my disposable income on experiences, whether that's vacations, family reunions, visiting friends, immersing yourself in new cultures. There is a strong and almost insatiable appetite for those sorts of experiences.
So given that outlook, where are you building some of your most important hotels or converting them?
Yeah, well, everywhere. I mean, we had a couple really exciting announcements at the luxury end of the market just this week. We're converting the Turtle Bay Resort on the north shore of Oahu, which is a stunning hotel. Blackstone did a massive renovation of that hotel before they sold it to Host. Host will convert that to a Ritz-Carlton. And then in Southern California, in Newport Beach, we're very excited. We reached a deal with the Irvine Company and Donald Bren to convert the Pelican Hill Resort to a St. Regis. So we're seeing lots of resort activity, lots of conversion volume, but at the same time, we're recognizing there's a value-focused customer at the other end of the spectrum, and so we are rolling out additional platforms in the mid-scale tier.
What does pricing look like at those value ends of the spectrums? I think there's so many people focused on inflation and how everything seems to be going up. What does the pricing look like?
Well, it'll be the most moderately priced range of products we have across our 30-plus brand portfolio. And so we've got 4 Points Express rolling out across EMEA right now. We've got City Express, the acquisition we did down in Latin America. I was at the groundbreaking for the first Studio Res here in the US, which is an extended stay focused mid-scale platform. And then we've got a code name here for Project Mid-T, which will be a transient focused mid-scale tier.
There's been some chatter in the various lodging publications of how interest rates still at these levels are impacting development, but they're also can impact once loans on hotels come due. Now you have decades of experience in development. How do you see this playing out?
So on the development side, it's interesting. You and I have talked about this in the past. The vast majority of our owners and franchisees are long-term investors in the sector. They understand that it's cyclical. I don't think they're hesitant because of interest rates. To be sure, that squeezes the returns, but their bigger challenge is just accessing debt. The debt markets for new hotel construction are very constricted in the US and in Western Europe. There's plenty of available debt capital for existing assets. But the irony is when you talk to these lenders, especially regional lenders, their hospitality portfolios are the best performing assets in their commercial real estate portfolio. The issue is they're all wondering what's going to be imposed upon them by Basel III in mid-25, and so they're hesitant to do a lot of new origination.
Our company group bookings have been very important for Marriott. What do they look like into the back half of the year in front of the election?
So in the first quarter, we were up 6% year over year. We're approaching double-digit growth as we look into the back half of the year. And this is anecdotal, but I was just at an event we hold every year called the Association Masters. We had about 400 association meeting planners, and it was fascinating. Almost to a person, their frustration was finding dates and space. They were saying to our teams, can we book 7, 8, 10 years out?
10 years?
I know. It's remarkable, but what it speaks to is the strength of that group demand.
You're a world traveler. You basically live out of a suitcase. Since we last spoke, the Biden administration put new tariffs on China. When you go to China and talk to your customers over there, how are American companies viewed? Are they getting concerned about any potential change in the White House?
Well, I was in China just a couple months ago. U.S. political scene is about the only topic anybody wanted to talk about. I wanted to talk about demand. Yeah. I wanted to talk about
cool new ways to get inside the room, with your phone.
And they all wanted to talk about my perspective on the election. As we've discussed in the past, one of the really great things about our China business, which is our second biggest market, we have a little over 500 operating hotels, another 400 in the pipeline. Almost the entirety of that portfolio is Chinese owned. And so it is, I think it insulates us a little bit from some of the friction that exists between the two governments.
Do they still have confidence in the U.S.?
They do.
It's good to hear. All right, Marriott CEO Anthony Capuano, good to see you. Good luck with
to
the
be here.
Hospitality Week.
All right.
City. Appreciate it.
Thanks.
All right, Madison, back to you.
All right, thank you so much for bringing that to us, Brian Salzi. Really appreciate it. We're going to get to some trending tickers we are watching this morning. We got to start with the big guy here, Nvidia. Those shares are up a little over 3.5% this morning after the company announced new AI chips. Bank of America moving on this news, raising their price target on the stock to $1,500 a share. That is up from $1,320, and this is now the highest call on the street. Now, Shauna, not only getting news from Nvidia this morning, AMD also announcing a new chip at this tech conference this week. And AMD is kind of the closest thing Nvidia has to a competitor, but I just pulled this stat that shows how far ahead Nvidia is from AMD. They grew sales by $100 billion in AI chips in the past year. AMD is expected to do $4 billion. So you really can't compare. That's 1/25th in terms of the comparison.
Exactly. You talk about just the sheer dominance that Nvidia has had over the market up until this point, and you talk about the new chips, what they have in the pipeline. Clearly, a lot of excitement surrounding what we heard from Jensen Huang over the weekend, and that's why you're seeing Nvidia, once again, a stock that had already been up 120+% heading into the weekend, up another 3.5% to 4% here today. So you talk about that runway for growth, and I think a lot of that optimism was reflected in this new price target that we're getting out here from Bank of America earlier this morning, 1,500. That's up from 1,320. And why? Well, they're bullish here just in terms of where we are in the sector. They're still saying that we're early in the cycle here for the sector. AI tailwinds and solid free cash flow. They see near term, it might be a bit stretched, but the semiconductor cycle has legs for another 12 to 18 months. So again, when you take into account that 1,500 call, that's about 37% upside from where we are today. So still many analysts on the street remaining extremely bullish on this name. You can see investors clearly getting excited by some of the announcements that were made over the weekend. And still, it just really shows that we are maybe, in fact, in the very, very early innings of the AI adoption cycle and the AI investment cycle when it even comes to some of those CapEx trends as well.
Absolutely.
All right, well, let's turn to another trending ticker here at Yahoo Finance, and that's Spotify. It's moving higher, up nearly 5% after the company announced that it's increasing the cost of its premium subscription plans in the U.S. Now, this is Spotify's second price hike in a year. Yahoo Finance's Alexandra Canal has the details for us, Allie.
Yeah, we're seeing shares up about 5%. Shares were up as much as 6% earlier today after those fresh batch of price hikes that we're getting to those U.S. subscription plans. According to Spotify, prices will rise between $1 to $3 a month beginning in July. The family plan, that saw the largest increase, with prices rising to $19.99 a month. That's up from the prior $16.99. Duo plans that allows two users to be on the same account. Those subscription plans will increase by $2 to $16.99, and then Spotify premium subscriptions will now cost $11.99 a month, which is an increase of $1. Now, in a blog post, Spotify said that this is due to the fact it wants to continue to innovate and offer the best possible experience for consumers when it comes to not only audio, but also music and audiobooks and different initiatives there. Spotify did boost the cost of certain subscription plans last summer and previously hinted that they want to offer more flexible subscription plans down the line. CEO Daniel Ek, he confirmed that an audiobook only tier will be coming to the platform, as well as a music specific tier. So this is all part of a greater push to really increase profitability, boost margins. The stock is up considerably higher compared to the year ago period, up more than 100%, up about 60% year to date. And if you think about where this company was even a couple years ago, they've made significant strides. Analysts on the street, they've been consistently bullish on the move, saying that this is an effort for the company to really boost that top line growth. So, I'm not surprised to see that these price hikes are coming now. Of course, just another added thing for the consumer, though.
It feels like the latest price hike from one of my many subscriptions,
yes,
right?
Exactly.
This is just another one.
Bad news for the consumer, but if you're a shareholder, pretty happy with the stock.
Yeah, exactly. And again,
and the massive run-up that you were just talking about from a year ago.
Right. And we saw them spend so much money on the podcast boom, and now they're being a lot more strategic with how they're spending it. This is just a consequence of that.
Yeah, All right, Ellie. Well, thank you so much, as always, for bringing us the news. We appreciate it so much. We're moving on to another trending ticker here. Waste Management will buy medical waste disposal company Stericycle in a deal that is valued at about $7.2 billion. Now, shares of Stericycle jumping this morning after the deal as much as 15%. Shares of WM, though, moving to the downside, hitting just under a downside move of 3% off of this move. Now, this may be putting some downward pressure on the Waste Management stock, which is positioned to become kind of a leader in the U.S. medical waste management space after this move here. But we're seeing that downward pressure potentially because Stericycle's latest earnings prints were not very successful. They had some earnings compressions, some limited synergies between the solid and medical waste businesses that Stericycle has to offer as well. So potentially the street viewing this as a negative move. I would be surprised to see that it's because of the dollar amount at $7.2 billion, though maybe that is considered as expensive, and that's why we're seeing some downward pressure on that stock. But still remains to be seen. Citi saying this morning that this could really position WM to be a leader in this space that's already such a big leader in moving forward.
Yeah, when you take a look at some of the reaction that we are seeing here, or at least comparing the reaction that we're seeing to what Waste Management thinks as a real opportunity within this space, and you take a look at the fact that Waste Management sees it adding to earnings and cash flow growth within 1 year of the close. And again, this is expected to close as of the end of the year, so as early as the fourth quarter of this year. So again, they're viewing it as a strategic move that makes sense. Clearly, that is why they are buying this company. And quick analyst reaction here saying that such a deal would allow Waste Management to leverage its scale and also national platform to generate some of those quick synergies on improved route density and also accelerate some of that ongoing consolidation within the smaller players of this space. So again, we're seeing that reaction in shares of Stericycle. That's hitting a new high here. Waste Management shares off the lows of the session, but still under early pressure here today.
Yep, and seeing both of those names hitting our trending tickers list on the Yahoo Finance platform as well. We're going to have all of your markets action ahead. Stay tuned for more. You're watching Catalysts.
EV sales growth is slowing this year, prompting auto giants to scale back and adjust spending plans, and many to reduce costs. Tesla, one of those names, forced to cut about 10% of its global staff in April amid concerns around that softer demand. Yahoo Finance executive editor Brian Sazzi spoke to Ford CEO Jim Farley in an interview about EV demand and what are some of the trends that he's seeing. Let's watch.
We think almost half of Americans would save money by buying an EV. Let's take the politics out of it. You know, we think for customers, they love the flexibility. They love not having to go to the gas station. They love having a full tank every morning. They like having a digitally enabled car that normally comes with an EV. There's a lot of incredibly attractive consumer aspects of an EV. I think it started off as an expensive technology and one that was really dominated in the urban world where, you know, politics play out. And of course, with the charging infrastructure and building a whole new infrastructure outside of gas stations, it was bound to be, you know, politicized. But that's not what we're focused on as a company. We're focused on the customer. We're seeing customers who buy a Mach-E or a Lightning, they don't go back to an ICE vehicle. It's like a different experience for them, and they don't want to go back to the other experience.
I do like smelling gas. I mean, that's just me. That's my thing. Maybe I'm the last of a generation. Maybe you understand where I'm coming from. You race cars.
Yeah.
You get it.
No, I think there's room for plenty of us, but there's a lot of people who like, you know, who don't like going to the gas station at 2 a.m. A lot of people who like the comfort of knowing they're filled up every morning. A lot of people who take comfort, forget about the green aspect, or just instantaneous acceleration. You're on the highway, you want to pass someone. An EV is just an amazing experience.
Mm-hmm. Is it hard to stay committed to EVs? I mean, you're a public company. Ford has said it's going to lose $4 or $5 billion, whatever it is, on EVs this year. Is it hard to stay committed to that vision when these losses are happening? And how long do you stay committed to it?
Well, I think, first of all, we're not going to invest in the future of EVs unless we're convinced we'll be profitable. Mm-hmm. So that's my job. I'm not going to allocate capital to my leadership team or anyone in the company if we don't think we're going to be profitable in the next cycle of products. So, you know, that aspect is kind of undeniable. It's unnegotiable. Mm-hmm. You know, we really believe in the consumer experience for an EV, and so we want the next ones to be more affordable. And that's why we're investing in more affordable EVs in the next cycle of products that people see from Ford in the next couple of years. We're number 2 in EVs in the U.S. behind Tesla, a long way behind, but we're still there. And people love their Mach-E's and Lightnings, and they're going to like the new ones even better. What's hard about it is making the physical changes to be profitable, to bring the cost down, to have large unit castings, to really change the way we engineer the vehicle to minimize that size of the battery, because the battery is so expensive and such a big driver of the cost. So the hard part for us is delivering and executing on affordable EVs that make money, just like Henry Ford did with Model T.
All right, so Jim, why, you were just breaking down EV production a little bit, why are EVs still so expensive?
You know, the reason is the NCM batteries that have cobalt and lithium and nickel in them are very expensive, and they're very heavy. On a Lightning, that battery could be $30,000, $40,000. A combustion, you know, at scale, a combustion drivetrain is going to be, you know, 10% of that. And so really it's the batteries and the one-time investment for building the battery plants and the manufacturing facility and engineering these very different kinds of vehicles. The actual engineering of the vehicle, the parts that require to build an EV are totally different than an internal combustion engine vehicle. You have inverters and you have electric motors, and they have to all be integrated, and there's high voltage electricity that has to be managed. There's fire risk in the NCM, and all that adds cost. What's exciting, and we're the first one to invest in these lower cost batteries in Marshall, Michigan, is there's battery chemistry out there, iron phosphate, that's much cheaper, like half the cost. And we're going to be the first ones bringing that to U.S. customers. And that's just the beginning. We're going to have a whole low-cost platform. And what we've had to do is completely change our execution. We had a very American idea. The Skunk Works team in California, filled with a lot of Tesla and Apple people who don't have the prejudices that I would as a old school car person, and they are engineering a completely different approach, a different product at a different cost with a much smaller battery and different chemistry that we're very convinced it will be not only profitable, but it will be affordable for most Americans, and it will be fully competitive with the best in the business, which we think are the Chinese.
When does Ford make money from EVs? Is there a date on the calendar?
Yes.
There is. Any date? Years? A couple of years? Is it? Do you go from losing what, $5 billion to maybe like $2 billion and then break even and then?
I think the first generation we have a lot of opportunity to improve our losses. But until we get to the second generation, which we start to roll out in the next couple of years, that's when things turn around. And as those products scale and become a bigger part of our EV business, you'll see the business turn around.
Why is China so good in some of these things? The software, autonomous. What are we not doing as a country?
A couple things. I mean, they really bet on EVs. You know, the government got completely behind this technology many years ago. And they supported the companies with tax advantages and registration advantages and free subsidies for the customers. They invested in battery technology like CATL, which is the leading battery company in the world, is Chinese. I think what we have to do is take the IP that's been developed there and localize and get close to it and learn how to do it ourselves. That's what we're doing in Marshall, Michigan. I think they made a strategic bet, and it's paid off so far. But after 120 years, we've seen a lot of competition. Mm-hmm. We've seen competition from every country around the world, and there's always going to be someone new. And I think what I find at Ford is there are times when the company really rejuvenates itself, like the 80s and 90s, like the 50s, like the 30s. And I believe this time, in the mid-20s, we're going to be revitalized again with a whole new commitment to cost and quality and innovation.
Not to be a total name-dropping geek, but we got to spend some time with the president on the day that he announced tariffs on China. Mm-hmm. Will those tariffs on China help Ford? On China EVs, I should say.
I think tariffs are an important part of leveling the field for time frame, but ultimately Ford has to be fully competitive on cost and quality with whoever we compete with, including a BYD or the Chinese players. And we have a plan to do that. In the meantime, the government has a job to do, just like we face competing in China as an American company. They have very strict laws around privacy. You know, you saw Elon having to go there to get permission to have his self-driving system approved by their government. You know, they have policies where the government requires all the privacy data not to leave China. And we need this reciprocating policies around privacy and national security for these vehicles that can be autonomous.
Thank you, Brian Sozzi, for bringing us that interview with Jim Farley. Now, you can catch that full interview with Ford's CEO on yahoofinance.com and, of course, on the opening bid. We're going to have all of your markets action ahead right here on Yahoo Finance. You're looking at a mixed picture across the major indices, with the S&P slipping into negative territory, but the NASDAQ holding on to gains. We'll be right back with more.
JetBlue shares are gaining this morning after noting healthy demand, lifting the bottom end of its revenue guidance for the second quarter. Now, sales are now expected to fall between 6.5% and 9.5%. Might not sound too rosy, but that's actually better. It was actually compared to its previous forecast of a decline of up to 10.5%. So we have this pent-up demand for travel. We heard from the CEO of Marriott earlier on in the program talking about this willingness to spend of travelers. They're out there. They want to take those trips. Clearly, the airlines are benefiting from this as well. When it comes to some of that outperformance there, this is also coupled with some of the data that we're getting out from the International Air Transport Association today, saying that they expect 2024 to exceed those initial expectations, and for net profits expected to reach just over $30 billion. So again, JetBlue benefiting from those lower fuel costs that we've been talking about, able to cut some of those expenses, and as a result, lifting the bottom end of their sales range.
Yeah, and lifting a lot of airline stocks with them right now. Interesting commentary from Vital Knowledge this morning saying this is obviously positive news after American Airlines last week cut their forecast. That put a lot of downward pressure on several stocks in the airline sector. Taking a look at the S&P 500 Super Composite Airline Index, that slumped as much as 5% off of that American Airlines news last week. This morning, that exact index, that super composite of airline names, is up a little over 1.5% at one point this morning off of this JetBlue news. So certainly welcome information for a lot of these airline stocks. But Vital Knowledge does continue to note that this is not exactly a material change on an absolute basis. The changes here are minor for JetBlue, still looking at some pressure in the quarter when it comes to their revenue outlook. That is not the case, though, for every single stock across the board. We continue to hear great news for Delta Air, which is seeing a little bit of downward pressure today, maybe coming off of its highs, but seeing some upward pressure for some of the names that have upward movement and momentum, rather, for some of the names that have seen some pressure as of late, like the JetBlues, the American Airlines of the world, Shauna.
Yeah, JetBlue has just been in a tough spot ever since its bid to buy out and acquire Spirit was blocked several months ago. So they've been trying to figure out how they are going to compete with those other larger names, some of the names that you just mentioned there within the sector, especially those domestic players. They're trying to be competitive on price. Also, we have this talk about the supply issue that is impacting not only JetBlue, but many of these airlines as well, just in terms of getting the flights in the air that are needed to meet that demand. So again, lots of questions just about what exactly the short term is going to look like, especially for a name like JetBlue. But again, lifting the lower end of its guidance, so maybe it won't be as bad as investors had initially feared.
It's a great point, too, though, about JetBlue and the Spirit deal, because it points out that it's not always macro news only for the airline. Sometimes it's company specific. Well, coming up here, we are going to get to wealth dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you for the next hour. He'll discuss how retail traders can play the meme stock rally. Stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts are going to give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, the meme frenzy rears its head again. Wall Street abuzz with GameStop's massive surge on speculation. The trader Roaring Kitty holds a big position in the stock. We'll ask an expert how you can play the trade. And what you need to know before starting your own business. We go directly to the source. We ask a small business owner who met with members of the Biden administration last week. Plus, the challenges each generation faces when saving for retirement. We'll get you better positioned to save by identifying the right plan for you. All that and much more during today's show. But let's begin on this meme stock move that we're tracking here today. GameStop skyrocketing right now. It's up by about 29% as it's holding on to gains, as we had just seen there on the screen. This after a Reddit account linked to Keith Gill, also known as Roaring Kitty, posted what appears to be ownership of a significant amount of shares and call options. Now, we should note we could not independently verify the validity of the post. In case you don't know, though, Gill is widely credited for influencing GameStop's 2021 short squeeze. For more on how you can take part in the meme trade, should you so choose, we have Matt Kors, host of the Matt Kors Show. So Matt, we were discussing this earlier during the 9 a.m. hour as well, and one of our guests from Interactive Brokers, Steve Sosnick, pointed out that you shouldn't be chasing certain trades, but there's a difference between a trade and an investment decision, as you and I have discussed in the past.
Yes, 100%. And I guess I just really want to reiterate that to everyone listening to this. Trading and investing, the way I like to describe it, the best metaphor I could come up with is the fact that they are two completely different sports that happen to be played on the same field. And time again, we see a lot of people who maybe they get into it for one reason and then they switch to the other side during the trade or the investment because things aren't going right. And I just want everyone listening to know whatever your plan is, stick to it and don't change it halfway through the game.
Yeah, I'll pose this question to you as well. I mean, we talked about the historical element of this. Everybody remembers when, everybody and their grandmother was talking about the ticker symbol GME and AMC, and what the thesis was back then. It was to really make sure that everybody and the little guys and the retail traders out there were kind of ganging up on the big money, those who had heavily shorted GameStop. What is the thesis at this juncture from the best kind of analysis that we could layer onto it when you don't have that type of outsized short position that a lot of the institutional money has built up?
Makes me think of the old adage, don't let the truth get in the way of a good story, because right now that's still the story. And as you just alluded to, the short interest is nowhere close. Back in 2021, it was 120%.
Yeah.
As we're talking right now, it's around 19%. But right now, people are still buying into that classic David and Goliath movement. And it's working because overnight, GameStop added $5 billion to its market cap. Now, does it have the same juice, the same, underlying ingredients to make something go crazy? It's kind of tough because don't forget, back in 2021, not only was there a sky high short interest of 120%, everyone was locked inside looking for some sort of community. Interest rates were at zero. People were getting stimulus checks. Right now, we're just in a different place in the world. So I wholeheartedly believe money could be made to both the upside and the downside. But in my personal opinion, this is much more of an active trade, not an investment where you would want to chase it after pumping 30%.
Yeah, we're taking a look at GME shares right now on screen, and a lot of our viewers who are old enough to remember where it was trading at earlier in the session remember seeing it up 70%, almost 80%. Right now, it's only up by about 30%, still not shabby of a gain. But what does this tell you about the meme frenzy, if you will, or just the mindset in terms of how long a momentum trade can last versus the time period before, where we saw it go on for sessions, weeks almost?
Yeah, that's an excellent question. And I actually believe the momentum could be carried for a while. I think really momentum's going to beget more momentum. So as long as things are trending, I think there's actually a greater chance of it continuing to trend, especially because of some of the underlying excitement of what's going on in the options market. If people continue to pour into it, it's going to end up becoming a self-fulfilling prophecy. So it's kind of really how many people buy into the concept of the movement as a whole.
And when you think about, of course, just this one name, there's so many others that kind of got pulled into the broader mimetic mindset, if you will. Where are the other perhaps opportunities that are out there for those who are trying to figure out, okay, I don't want to chase GameStop, but I want to best anticipate where some of this flow could be moving around?
Yes, like you said, a lot of those related names are getting a similar sympathy reaction. But in my book, it's kind of really hard to be better than or really duplicate the original. So I think most eyes, most trading, most excitement is on GME. But that other basket of quote unquote meme stocks, yeah, there's going to be some sympathy there. But in terms of how to play it, how to trade it, as you alluded to, by no means would I chase. If I do want to go in, understand that it's a high risk, high reward play. Obviously, never put more money on the table than you're willing to lose. And I think right now there's maybe potentially a lot of novice people joining the market thinking that every single day is the same in the options market. And I want to clarify to anyone listening, and this is maybe potentially a bit more of a deep dive, volatility is extremely high. So whether you're buying calls or buying puts, there's a good chance that you're overpaying.
Matt, great to see you. Thanks for hopping on with us to break this down. Really appreciate it. Matt Kors, the host of the Matt Kors Show.
Thank you.
Thanks. Well, inflation continues to hit Americans' wallets, and they're certainly feeling the burn here. According to a recent CNET Money survey, 188 million adults in the U.S. have had to postpone purchases or significant financial goals due to sticky inflation and higher prices. Here to break down the report, we've got Deja Milden, who is the CNET Money editor. Great to see you. Thanks so much for joining us. Help us walk through some of these results. Was there anything that jumped out at you in terms of what people are willing to or need to push back in terms of purchases right now?
Yeah, good morning. I think the one thing that's the biggest takeaway right now is that the biggest sticker shock is groceries. That's 77% according to our survey. And then it's followed by another essential, gas, which is at 54%. So it's clear that what we're seeing is that people are surprised by what they're having to pay for essentials, and they don't really have what it takes right now to put more toward those longer term goals that we just talked about, right? The vacations, the homes, the cars. We even saw, according to our survey, that people are having to tap into credit cards, buy now, pay later, their savings. So it's really clear that we're having to take a closer look at our budgets and, more importantly, what that means for our money now and in the near future.
Yeah, Deja, when we get all of these different readings about the consumer, I mean, we got consumer confidence last week, and we were discussing even with the conference board, their chief economist Dana Peterson hopped on with us to really discuss what their view of the consumer is right now. And we've seen this moderate over the past about 18 months or so, going from the consumer, hey, it's resilient, or we are the consumer, to all the way to this juncture where you're hearing companies like Walmart talking about the consumer being relatively consistent or relatively stable. That's a far cry from resilient or saying that there is all-out strength. So how do you define, and how are you in this data seeing the consumer, and what is that definition of them from your perspective?
What we're seeing right now is that consumers are really having to think about essentials. For them, that may look like still visiting Walmart and Target, but really being mindful before they hit that checkout line, right? So what we're seeing also is that a lot of those companies and retailers are able to slash prices right now. They're cutting back on, let's say, a lot of those essentials, slashing prices a bit, and it can work in our favor. That being said, we're reaching a point where we're having to boil down what it really means for our budget. Those savings that we're seeing can really help us to save a little bit more on groceries, like we just talked about, saving on gas a little bit more. So it makes it a little bit tougher to really see the consumer really having to plan for long term, when right now, a good portion of America is just trying to get by.
Yeah, certainly. And one of the huge things that we're also trying to get our heads around is where they're going towards as they're trying to get by. Has this changed where they're shopping?
I'll say for many of Americans, we're looking at what it means for when it comes to comparison shopping. So yeah, that comes down to going to different stores, choosing different brands, even considering wholesale clubs. We talked to our expert review board, and we are seeing that people are shopping their pantry first before even visiting the store. So that can look really different depending on the consumer. But more importantly, the bigger picture takeaway there is that we're doing anything we can at this point to save money, to cut those costs down.
It was interesting, too, and just lastly, while we have you, you laid out the impact on each generation as well in some of the findings from this. What was the main takeaway there?
Millennials and Gen Z. Millennials are not planning right now. The majority of millennials are not planning to handle those long-term goals and purchases right now, the homes, the vacations, the cars, and even more so, they're having to tap into savings. A fourth of millennials are having to do that in order to cover the essentials. So right now, it goes back to, hey, right now might not be the time to buy that home, even though prices and interest rates may look favorable depending on the consumer. Right now, essentials are the biggest key in making sure that everyday life is taken care of.
Deja Milton, who is the CNET Money Editor. Deja, thanks so much for taking the time here with us today.
Thank you for having me. Have a good one.
Certainly, you too. Guys, coming up, small businesses make up almost all of the U.S. businesses. Yeah, it does indeed. But it's not easy to start one. We've got some tips for all of you aspiring business owners on the other side of the break. Over 99% of businesses in the U.S. are small businesses, according to the Small Business Administration. And there's been a boom in small business applications. Over 17 million applications, in fact, were filed since 2021, according to the Biden administration. Our next guest was at the White House last week to discuss priorities and resources for small business owners. To break it all down for us, Suzanne Stantley, who is the BE Group Inc. founder and CEO, is here with us. Thanks so much for taking the time. Fresh from your visit to the White House, you got to walk us into what's being discussed, what's being prioritized for small business owners and potential entrepreneurs out there looking to start their own small business.
Good morning. Well, the visit to the White House was extremely enlightening. The Biden administration has so many programs that they have put in place for the small business. As you mentioned, in the last 3 years, over 17 million individuals have said, I want to start a small business. And those businesses, if successful, will add a lot of jobs and a lot of revenue to our economy. And so we talked about the Small Business Administration and all of the programs that they have in place for the small business. We certainly know that this department has been around for many, many years, but the programs that they have available for small business have grown significantly. There's been more money invested. Over $10 billion has been invested just to help small business with their capitalization and startup and technical assistance. We also discussed the Minority Business Development Agency and the fact that it has been made a permanent organization within the Department of Commerce, and that they are there to really assist small businesses to gain this fortitude and the stamina, as well as the insights and expertise to run a business.
Sounds like a wide-ranging conversation was had. I want to know, as you're kind of engaging with small business owners in your own work, how do you navigate some of the mistakes, the pitfalls that you see small businesses frequently make, and how can aspiring entrepreneurs and small business owners navigate that themselves?
You know, the most important aspect of starting a business is really understanding the industry that that business owner is operating in. Many people, like those 17 million that we talked about, have decided they want to start a business, but have they really done the research? Have they really conducted an analysis of the industry and the segment in which they operate in order to really have a good understanding of what they are stepping into? Running a business is not like running a household. There are so many variables that have to be managed, so many variables that have to be adjusted. You have to understand employment and staffing and healthcare and health insurance and payroll. So these businesses really need to undertake a full understanding of what they're getting into. And that's why these agencies that the federal government has in place are there to assist these small businesses. I talked about within the Small Business Administration, there are several departments, and I just want to enumerate some of those. You have the Small Business Development Centers, which are around the country, there to assist small businesses in understanding what the industry looks like that they operate in. You also have the SCORE Business Mentors. Those business mentors are there to provide advice. Those small businesses can ask questions and receive answers. They become the guideposts for those businesses as they begin to make the decision to launch their businesses. You have the Veterans Business Outreach Program. Of course, veterans have a number of services available to them that are not necessarily available to all small businesses. And then you have the Women's Business Development Centers. Mm-hmm. So no matter where a small business operates in this country, they can access those particular agencies and get assistance and support.
One of the viral sayings of a few years past was where the money reside. And a lot of small business owners want to know, where is the potential free money that they can get in order to make sure that they are putting that capital to work for their small business?
Well, you know, free is an interesting term. And most of the businesses' access to capital programs reside within the Small Business Administration, as I mentioned already, and the Minority Business Development Agency. The Biden administration invested $10 billion to support small businesses and empower them to gain access to this capital that you just mentioned, which is critically important because without capital, a business can't operate. One of the issues with small businesses is that, again, so many of them may be experts in a specific area, but they're not experts in running a business. And so consequently, they need to have the tools in place to operate their business.
Suzanne, great to speak with you here on the day, and thanks so much for laying out so much of the access points for small business owners who are either already embarked on their journey or just beginning a new one here. Suzanne Stanley, who is the BE Group founder and CEO. Thanks so much.
You're welcome. Thank you.
Certainly. Well, starting your own business is one thing, but paying your taxes on your small business, a whole other beast. Joining us now with some advantageous tax tips for your small business, we've got Mark Kohler, who is the KKOS Lawyers Senior Partner here. Mark, great to have you here. You got a better looking microphone than I do here. Let's begin as we're kind of thinking about some of the strategies that small businesses are trying to employ for best tax savings. Where should they begin? What's number one, the lowest hanging fruit?
Well, first, thanks for having me. This is such an exciting topic, right? Talking about taxes. Everybody's been waiting for this, Brad. I'm so grateful you guys are dedicating time to this. This is awesome. First big thing is for a business owner is to realize they've got to find an advisor and maybe get away from someone that's just reporting their taxes. They're out there, they could be a little hard to find, but when you find an advisor, you're planning your big picture. A term we use when we work with our clients is trifecta. We want to bring it all together with operations, the assets we're investing, and then bring it down to our trust or 1040. And with this trifecta blueprint, when you have a big picture, you know the direction you're going. And then you can start popping in those tax strategies that really move the needle.
With that in mind, what are some of the hot button tax topics that you hear your clients asking about as they're trying to best position themselves to take advantage where there are kind of loopholes that they can tap into?
Oh, you bet. And small business owners are starving for good tax tips, and they just want some actionable items. And the one we love the most is right up there in the top three is the S corporation. The S corporation, and you could have an LLC taxed as an S corporation, but when business owners start to get around $60,000 in net income, so gross minus all my expenses, I'm taking home around 60. I need to be looking at converting to the S corporation. Very affordable to do, very simple to maintain. But what you're doing is saving on the number one tax before state and Fed, and that's FICA. And we want to save on self-employment tax. A lot of accountants can be too conservative there. You got to drive your own car here, people. You're the captain of your ship. So have a conversation or review with someone about the self-employment tax issue, and you actually reduce your chances of an audit. When you move to an S Corp, now you're filing on a different tax return. Super exciting.
Mark, our team did the homework. I mean, you've been an entrepreneur since, sounds like the age of 15. We've had a lot of tax code changes since then, especially for small businesses. Is there one that's more outsized in terms of those changes than the rest that small businesses should be tapping into?
You bet. And the technique that brings a lot of the strategies that's come about in the last 6 to 8 years with the Tax Cuts and Jobs Act is using the family board meeting. I love the family board because business is family, family is business. And so too many business owners, Americans, pay taxes and then support their kids. Under age 18, they may be going to college. And so they pay taxes at these higher rates when they could get the kids involved in the business. I want kids, spouses, the parents, any family members you're supporting on a family board. Now, what that does now is it teaches them business, financial literacy. You're getting their help. You're taking tax write-offs for travel, dining, having regular board meetings where you travel within reason. And we're now getting income into those kids' tax returns where they can build credit, pay for their own tuition in college. It's just building that legacy. And Main Street America is the backbone of this country. And when we involve our family, we're passing on a legacy.
Mark Kohler, KKOS Lawyers Senior Partner. Mark, thanks so much for joining us here. Really appreciate it.
Brad, thanks for having me.
Certainly. Coming up, everyone, feeling stressed about your retirement plan? Your stress level may have something to do with the generation you grew up in. I'll say. Our next guest will break down how each age group feels about their retirement savings. That's next. Retirement planning has changed a lot over the last few decades. About 30 years ago, you could work for the same company for years and know by the time that you're ready to retire, there would be a defined benefit plan, also known as a pension fund, just waiting for you. Now, most retirement is built on defined contribution plans like 401ks, which largely rely on workers to contribute their income while employers may contribute some as well as a benefit. So, with how much retirement has changed over the years, how different generations are dealing with the planning for this and for the future, it can vary. Joining me now for more on this, we've got Chris Cedar, who's the Goldman Sachs Asset Management Senior Retirement Strategist. Chris, great to see you here. Okay, so which generation is feeling kind of the biggest hit of the changes here that have taken place over the decades?
Sure. Yeah. No. Nice to spend the time with you today. One of the challenges that we have with the generational shift from pensions to 401k plans is really that shift for Generation X. Generation X at the time, really, they were late to basically understanding that so much of the responsibility is now going to sit on their shoulders. So being able to save early, which is so critical to being able to have long-term savings accumulate, is really where we see one of the bigger challenges. So Generation X and obviously those late career boomers, or basically those still working boomers, are really the two generations that we see are struggling or feeling the most behind in their savings. And hopefully we'll have basically the next decade or so to really see where they can shore up those savings.
How has Gen X then gone about making sure that they can perhaps best fill the gap where there has been this drastic change and they were kind of the experimental generation to make sure that they are ready for and adequately have their number met for retirement?
Yeah, no, and that's the challenge. That's exactly the challenge. Time is basically our biggest friend when it comes to retirement savings. The earlier you can save, the better. So right now, Generation X is really thinking about how do you maximize the tax-deferred savings, looking at 401ks, potentially looking at HSA accounts, FSAs. What are the different types of tax advantage solutions that they can take advantage of basically in the last, last half of their career? Really looking at those aspects. The one area that we continue to see is a gap that we think would make more sense if we could really focus more attention for the Generation X is planning. We certainly don't see the plans there, but that's going to be something that's going to give them a better course of action to figure out how do they basically navigate some of the trade-offs between saving for college or dealing with elderly family members, navigating those challenges while also saving and maximizing their, basically their opportunity to get tax-deferred savings is really going to be critical in the next several years.
Let's talk about the younger generations as well here. Is there a massive delta between how they are planning for retirement than those generations that may either be on the way to retirement or in retirement right now, and how that planning looks vastly different, especially with a lot of, quite frankly, the digital resources that are available now too?
Yeah, no, that's exactly right. And so, for to take a step back, we generally see that this concept of the financial vortex, which is all these competing priorities that do impact your retirement savings, Generation X, as we call the generation, the experimental generation, they were first to deal with that. But as we look at sort of millennials and Gen Z, they also face significant pressure with those competing priorities. They're just at a different phase of navigating those challenges. So if you think Generation Z, the millennials, they are the most who actually feel like these competing priorities are going to be impacting their retirement. But they're just at a different phase of where they are in the process. But they're both feeling much better about where they are in their savings. They're much more proactive around saving for retirement, more than the other two generations. Gen X and working boomers have a personalized plan. So to us, it's really showing the fact that these younger generations have taken more of the ownership of really making sure that their financial security is one of their priorities, and they're making good progress, and they're getting out of the gate pretty well.
What do you believe the next big innovation on financial and retirement plans could be next?
Yeah, and innovations are really, really important for this, because what we're trying to do is you're really trying to help a very broad-based population. All employees or all Americans really need to be taking a bigger role. So what we've seen in terms of helping in the past is really automating a lot of the features, which has gotten people off to the ground. They're making savings. They're making the steps that they want to, get their savings off the ground. But what's missing is the planning aspect of it. And we actually talked about it in a couple of segments prior. Planning is so important. As we think about retirement journey today, it's so unique to what's going on in the individual's lives. Again, when they may be dealing with student loans, they may have, again, parents that may be living with them, or they're financially caring for their parents. Everyone is going to have a more unique circumstance that they need to navigate. And so the aspect of planning is so critical. And to your point around, technology, how that's playing a larger role, more of these services are being technology enabled. So building a personalized retirement plan, a lot of times that is actually now technologically available in many retirement plans today. It's not broadly available, and is one of those innovations that we continue to see is playing a really huge role in the future, so that we can help individuals not just get started, but also be able to manage all the competing priorities and their unique circumstances so that they can chart their own course towards retirement.
Chris Cedar, who's the Goldman Sachs Asset Management Senior Retirement Strategist. Chris, thanks so much for taking the time here with us today.
Great, thanks for having me.
Certainly. Well, it's that time of year when college students put on a baggy zip-up robe and a square cap and sit in the blistering sun waiting for their name to be called. I mean, mine was indoors. Graduation. It's a happy time. It's a whirlwind of excitement and accomplishment for these young folks. But it can also be strange to go from a college campus to the quote, end quote, real world, where there's jobs to do and bills to pay. So here, with all the money tips that grads should know, we've got Yahoo Finance's Carrie Hannon. Carrie, yes, it is a round world, and it's a very real world out there. What are the first couple tips here?
Yeah, Brad, absolutely love this time in people's lives. Number one, set big, audacious goals. If you're going to start saving money, you've got to have a vision for what that is. You've got to dream to get there. And so, money might not buy happiness, but it buys you freedom to live the kind of life you want, to do the things you want to do. So I encourage people to, start a vision board. What are you saving for? It is so helpful to be able to not just have a dollar amount, but to visualize it. And the second thing that is hugely important is don't get caught up in credit card debt. It is so tempting at this stage in your life to think, oh, I'll just pay it back later. But the fact of the matter is, debt is a dream killer. And you may find yourself stuck in a job because you need to have a certain salary to pay back those bills each month. And so I really encourage people to just try very hard to avoid debt.
And Carrie, a lot of young adults, new grads will arrive at their jobs, have to make decisions about contributing to retirement savings account when they're like, well, wait a minute, I'm still trying to take care of this debt that I just amassed over 4 or 5 years. So what are your tips there as they're looking out into the future and trying to make the smart decisions?
Yeah, this is a tricky one because you do say, I don't have enough money to set aside in my retirement account. But absolutely do as much as you can, even if it's a small amount. But if you can possibly, if your employer offers a retirement plan, try to get up to the match, 4 to 6% of your salary. That will, really be super helpful to you. You can bump it up as you go along. If you're working for yourself, automatically start an individual retirement account, an IRA, and automatically put a little bit of each paycheck into that. If you get confused about, oh my gosh, well, what should I be investing in? And your employer will offer lots of opportunities of different kinds of funds. I suggest start with a low-cost index fund. This is easy. It's really broadly diverse. You start with a U.S. stock fund. You can do an international fund, index fund, and maybe a little bit of bonds. But right now, you really want the equities to really give you the most growth over time and compound. So if you're really confused, just go to I love the S&P 500 index. It's been a great return over its history, and you can't go wrong. There's some cool stocks in there as well. You got Microsoft, you got Amazon, you got Tesla. But the other thing here is do not raid your account if you switch jobs. This is super tempting to do, especially if it's just a small amount. You go, oh, what the heck, I could use that to pay off these bills or to go on a trip. Don't do it. Let your money continue to grow for you.
Carrie, great tips here. We do have a little bonus activity, though, a little more fun in this conversation. What can you tell some of the fresh grads about enjoying spending their money?
Yeah, this is something my dad told me when I graduated. He's like, set some aside to spend on fun things, right? It's not, oh, yes, you have these big goals for your future, but save it in order to go do some fun things with your spending. And you know what? It's priceless. The return on this kind of life experience doesn't have your typical return on equity or whatever it might be, return on investment. This is a memories. These are memories. These are stories you tell your whole life. And I just encourage people to really build that kind of investment in your future as well.
Well, Well, in the words of Aubrey Drake Graham and Roaring Kitty, YOLO. Carrie Hannon, thanks so much.
Thanks.
Coming up, gas prices are expected to rise this summer. So, could the upfront cost of an EV be worth it? We'll talk about that next. It's a tough automobile market out there. Car prices have come down from 2021 highs, but other factors are giving consumers some pause. A new note from Bank of America points to the, quote, all-in cost ownership, which includes elevated interest rates, insurance, and maintenance costs. But one big auto executive thinks EV ownership could actually save Americans money. Yahoo Finance's executive editor Brian Sozzi spoke to Ford CEO Jim Farley about the consumer experience with electric vehicles.
We think almost half of Americans would save money by buying an EV. Let's take the politics out of it. You know, we think for customers, they love the flexibility. They love not having to go to the gas station. They love having a full tank every morning. They like having a digitally enabled car that normally comes with an EV. There's a lot of incredibly attractive consumer aspects of an EV. I think it started off as an expensive technology and one that was really dominated in the urban world where, you know, politics play out. And of course, with the charging infrastructure and building a whole new infrastructure outside of gas stations, it was bound to be politicized. But that's not what we're focused on as a company. We're focused on the customer. We're seeing customers who buy a Mach-E or a Lightning, they don't go back to an ICE vehicle. It's like a different experience for them, and they don't want to go back to the other experience.
And for more on this, we turn to Greg Migliore, who is the editor-in-chief of Autoblog. Greg, great to see you, and thanks for joining us on this topic here. I mean, you just heard from the Ford CEO talking about some of the potential cost savings that buyers of EVs long-term could potentially bake into their financial planning. Where is that stacking up in terms of the prioritization and the purchase decision-making that we're seeing right now more broadly among consumers?
Hey, good morning, Brad. Thanks for having me. I quite agree with Jim Farley. I think he's spot on. I think, with EVs, it's a technology that doesn't need to be politicized. It's just a good, interesting technology. I think it works for a lot of people, and for some people it won't. Perhaps they need to stick with, gas vehicles or hybrids, plug-in hybrids. But I think Jim is taking a very practical approach to the market. And he's also trying to take a measured approach. He wants to educate consumers saying, hey, maybe a home charger can work for you and that will relieve range anxiety. A lot of times when you install a home charger, you could get some tax rebates or incentives from either your insurance company or your utility company, things like that. With gas prices, it seems like they're always in fluctuation, right? And insurance rates and all sorts of maintenance costs are going up because the average age of a vehicle is hit, I think, 12.6 years. Vehicles are older and older. With EVs, there's often fewer maintenance costs, fewer maintenance chores associated with the vehicle. So I think trying to present it as a practical option for a lot of people could really resonate with a lot of American drivers.
It's interesting because we've got to kind of figure out where we are in terms of this cycle of, for the EV purchases, what's going to bring down pricing, number one. What's also kind of the general consumer sentiment around EVs as a whole, and have we hit and already moved through the trough in demand, as many of the companies are kind of entering into this demand generation phase and trying to get the messaging correctly as well. I mean, part of that was trying to make EVs sexy. Like, nobody was looking at the Leaf a decade ago or a decade plus ago and saying, man, I got to get in that car. Now, Tesla came along, Lucid came along, you've seen Mercedes come along with the EQ series, and ultimately that's added in this kind of this appeal to it. So where are we at in the cycle right now?
Yeah, I think we're sort of moving beyond that early adopter phase, and we're still in that spot where a lot of the early adopters have their vehicles, and then there's some skeptics, people who think, well, I'm open to the technology, but I'm not sure it's going to work for me. And that's where like an approach like what Jim Farley is taking could be very effective. I also think getting some more products, some more refreshed products on the market, to your point, Brad, could really help. Chevy's going to launch the new Equinox electric this year. They're expanding the range of the electric Silverado this year. So it's more, they're moving beyond just the work truck versions into some higher spec trims, things like that will help grow the market and offer consumers a greater variety of vehicles. I think a lot of it does come down to just a product decision. You're in the market for a new car. You think, hey, that Rivian looks pretty good. I'm interested in that. Maybe I'll go ahead and investigate that. Or, hey, I've had a Chevy Equinox for years. Now there's an electric version. Let me find out more about that. So I do think right now we're at like 8% of the overall market is EVs. I could see us getting to like 10 or 12% this year if some of these new product launches resonate with consumers.
It was clear in 2023 that the Cybertruck in the lead up to, and then in the kind of falling action thereafter, the ability to deliver a few of the vehicles and start to really move them into market, that was the story of 2023 for the EV market. Is there a clear or outsized winner right now in terms of mind share or even market share for 2024 that could potentially take the cake?
Right now, I think it's too early to tell. I do think Rivian, which unveiled a portfolio of new vehicles, I think in February or March, they look very strong. They're also refreshing some of their core models. That's the R1S and the R1T. Those are going to hit the market fairly soon. Like I said, Chevy has a whole fleet of electric vehicles, from the Silverado to the Equinox. The Blazer EV is going to get some, I think, critical mass this year. They're flooding the zone in like crossovers, which is a critical space. So I think basically as more and more products launch, again, we'll see how it shakes out. It's hard to really pick who's winning right now. I think it is a little too early. I know we're in June already, but I mean, right now I think it's, nobody's really achieved any sort of, pole position as we speak 5 months into the year.
Greg, always great to get your insights. Thanks so much. Greg Migliore, who is the editor-in-chief over at Autoblog. Great to see you.
Thank you.
Well, if you still haven't booked your summer travel plans, it may be worth it to use or sign up for a credit card that offers the best rewards. But which card is best for you? To help with some tips when making that important decision, we've got Yahoo Finance's own Kendall Little. Kendall, great to see you here in studio with us. All right, so for the folks that are still planning out those summer vacations, there are a range of card options that they could lean into for some of these rewards, yeah?
Yeah, exactly. I think when you are talking about travel credit card rewards, you really want to focus on one, your budget, and then how you travel. So say for instance that you're a really frequent traveler, you're always on the go, then you might want to look for a card where you can get the airport lounge access or the annual credits toward your travel expenses. Even if it has an annual fee, you're probably going to be worth that extra price. You also are going to want to look for rewards in categories that are travel related, whether that's airfare, hotel spending, so you can really maximize the costs that you're incurring when you're traveling a lot. And then on the other end of the spectrum, we have people who are beginners to travel rewards, who may only travel once or twice per year. In that case, you might benefit more from a low or no annual fee card that actually rewards you on your daily spending, so your groceries, your gas. Then you can accrue those points and miles throughout the year and then cash them in when you actually do travel. And finally, there's also the type of traveler who always uses the same airline, maybe they live in a hub city or always travels using the same hotel chain, then they might want to consider a co-branded card. And that co-branded card is going to give you benefits on the actual loyalty program for the travel brand. Maybe that means early check-in to your hotel or priority boarding on the airline. And you're also accruing those rewards within the loyalty program to help you reach elite status more fast. So I think depending on what type of travel that you're used to and your budget, that's really important to consider.
Now, back in March, the Consumer Financial Protection Bureau said that it would begin looking into credit card reward programs, and that was after a surge in complaints. So what are some of the most common complaints here?
Yeah, so in May, actually, the CFPB then released a report that went into detail on those complaints. And so generally, the credit card rewards complaints were focused around people who could not use the rewards that they had earned. For some people, that meant that maybe they actually didn't qualify or weren't eligible for a bonus that they thought they would be, or maybe their rewards program devalued those rewards before they could use them. Other people saw things like account issues and tech problems keeping their rewards in a limbo. And then there were also people who had their account closed or closed their account and just completely lost access to their rewards before they could use them.
Finally, we got to get to some tips for consumers to avoid having these issues in the first place, too.
Yeah, so I think the number one most important thing is probably the most boring thing is reading your terms and conditions.
Ooh.
Specifically, you want to look for rewards program terms. That's where you're going to find all the info about how you can make sure you qualify for a bonus, what purchases actually count for your rewards. It's all of the fine print that you don't want to read, but it's really, really important information to have. And then secondly, you should use your rewards. Don't just let them sit in your account forever, stockpiling them. That's how you lose the value of them. So if you have a cashback card, maybe at regular intervals throughout the year, you're cashing that in. If you earn points or miles, maybe you set a goal for a vacation and then you're using those rewards and accruing them toward that specific goal. What you don't want to do is just let them sit and never use them. So they get devalued or you lose access.
Yeah, terms and conditions, a good nighttime read if you're trying to get to sleep usually, but could be very valuable as well.
Exactly.
Kendall, thanks so much for taking the time.
Thanks, Brad.
Absolutely. Coming up, everyone, earnings season slowing down, but it's not over yet. We have one company's earnings that you, the consumer, should be paying attention to next. Dollar Tree will be reporting its latest quarterly earnings on Wednesday. Here to tell us what you, the consumer, should be looking out for is Yahoo Finance's own Josh Lipton. All right, Josh, this is going to be a big one, DLTR.
Here we go, Brad. All right, so listen, earnings season may be mostly behind us, Brad, but there are still important names reporting this week, including, as you said, Dollar Tree. Street's expecting Q1 EPS of $1.44 on revenue of $7.6 billion, which would represent growth of about 4% on the top line. The company in total operates roughly 17,000 locations. Remember, there are the Dollar Tree stores that are mostly in the suburbs and cater to middle-income consumers. There are also the Family Dollar locations that are mostly located in urban areas and sell groceries and cleaning products. Now, this is an interesting moment for the company as it is in turnaround mode. CEO Rick Dreiling took the reins of Dollar Tree last year, and he has been making changes, opening new stores, mostly Dollar Trees, but closing unprofitable Family Dollar stores. I checked in with Joe Feldman from the Telsey Advisory Group. He argues this is a smart strategy. Yes, Joe says it's going to create some volatility here in the near term, but in his opinion, it is building a solid foundation for the future. The turnaround has its challenges, Feldman says. An improvement at Family Dollar hasn't come as rapidly as maybe some hoped. That helps explain why the stock is down about 15% this year. In more recent news, the company also announced that nearly 200 shuttered 99-cents only stores are going to be reopened as Dollar Tree locations. It's after their leases were secured out of bankruptcy proceedings. Now, Feldman likes this move, saying these stores are in premium retail centers and complement the current network. More broadly, we do know the consumer that Dollar Tree caters to is facing challenges right now, including the impact of elevated inflation. Increasingly, shoppers seem much more focused on buying what they need rather than what they want. So how does Dollar Tree navigate this environment? Well, the company has been raising prices. Remember, they broke that dollar price point a few years ago. They went to $1.25 as a standard price point and are even testing higher priced items as well. In other words, bulls on the stock bet they can now sell fewer items but still maintain healthy revenue and margin growth. Brad, back to you.
Yeah, those Family Dollars, they were key to my financial planning when I first moved to New York. I was there so often, they might as well have just given me a badge. Josh, thanks so much.
You got it.
Appreciate it. Let's do a final check of the markets here as we're taking a look at the Dow, the S&P 500, and the NASDAQ. We are mixed right now. The Dow and the S&P 500 seeing some slippage. We did start the day in positive territory across the board. As we're approaching lunchtime here in New York, the Dow is down by about 0.7%, S&P 500 by about 0.2% in the red. NASDAQ holding on to gains, though, up 0.3%. That's it for Wealth Today. I'm Brad Smith. Thanks so much for watching. Hey, you can stay tuned for Market Domination, though, with Julie Hyman and Josh Lipton, who you just heard from, coming up at 3 p.m. Eastern Time. You do not want to miss it.